Would you like to be an expert in accounting in less than 5 hours? Well, if that's the case, then just watch this video a little bit every day and you will be an expert in accounting by the time you finish. Just sit back and relax and enjoy learning like you're watching your favorite education channel, and by the time you finish, you will have everything you need. My name is Mark Smolin. I'm the founder and CEO of Worldwide QuickBooks. I personally guarantee you the clearest possible explanation for every important accounting idea that a small business owner could need or an accounting student could want to learn. I answer all questions immediately if you leave them in the comment section below, and I promise to get back to you quickly and give you the best answer I can. I love hearing from all of you, and I know you'll enjoy this video. Let's start off by saying that everybody learns differently, and everybody listens differently too. That's why YouTube gives you the ability to change the volume right here in front of the video. And you should also know you can click on the cogwheel and adjust the playback speed to your listening pleasure. This way you can make it faster if you think I'm speaking too slowly, or you could slow it down if you think I'm speaking too quickly. And most importantly, you need to know how to navigate this video. The description field has the table of contents, and you can get to the table of contents by clicking the Show More button that's right under the video at the end of the description field. If you click Show More, the rest of the description field will open up, and it will reveal the table of contents. That'll give you the ability to click on the time index of the chapter you want, and this way the video will jump right to the place that you want to watch. So, I thank you very much for watching, and I hope you will click like and subscribe. And without further delay, I now present an introduction to accounting.
Part 1 has only one chapter, Introduction to Accounting.
Chapter 1. What is accounting?
What is accounting? If you can answer that question right at the beginning, then everything we do here will make perfect sense. Accounting is the way that companies record, summarize, organize, and present financial information. Let's look at that again. It's the way companies record, summarize, organize, and present financial information. Now, to explain this clearly, let's first focus on the recording part. We record transactions right now into the computer the same way that we recorded them on paper spreadsheets in the days before the computer. And then, once all of the transactions are properly recorded, we would simply summarize each area of accounting and financial data. Obviously, the summary numbers were very important. We would then have to organize these totals onto meaningful documents that would reveal how well the company is operating. This is an example of a profit and loss. It shows how well the business is operating during a particular period of time. Of course, we would have to organize all the financial information, and this is an example of another financial statement called the balance sheet. It shows what a company has compared to what a company owes. This is a very abbreviated version of a balance sheet, but it does give you an example of the financial position of a company at a specific moment in time. So then the question is, why do we do accounting? That's where the presenting comes in. We do accounting so that we can present our financial statements to people or organizations who need to know what's going on with this business. And you may well ask, who needs to see that information? Well, obviously, the owners and the managers of the company need to see how well the company is doing and need to see the financial position at different periods of time. And of course, everybody in this country needs to report their numbers at some point to the IRS. So, to summarize, accounting is recording, summarizing, organizing, and presenting financial information. And exactly how do we get there? Well, we get there by learning the ideas of debits and credits. Now come on, it's easy and fun if you try this video a little bit every day. Just patiently watch a little bit each day and you will be amazed how easy and fun it is to learn accounting.
Part 2. The story of debits and credits.
Chapter 2. What are assets?
The only reason why people think that the accounting words sound complicated is because the words are used in everyday life. But when we use these words, we're not using them the same way that we use them in accounting. We're using them as a metaphor for the way we would use it normally in accounting. For example, the word asset. We all know the metaphor. It means something good or helpful. For example, you might say, she's an asset to the team. However, the real meaning of the word asset is anything a business owns that has value. Now, most assets are tangible assets because you can physically touch them, like a car or a furniture item or a bank account. But there are other types of assets that a company could own, like copyrights and patents, and things that you can't physically touch, but things the company did pay for that they own that has value that will help the company earn money into the future. So you see, asset is an idea. It's something you can own that has value, whether you can touch the item or not.
Chapter 3. What are liabilities?
We even have the same issue with the word liability. The word liability is usually used as a metaphor. It usually means something that's a hindrance or something that would work against you. But the real meaning of the word liability is money or some kind of obligation the company must pay, give, or do in the future. So, if the company took a small business loan, that would be an example of a liability that you would have to record in the company books and records. If the company had a mortgage for a house that the company owned or a building that the company owned, that would also be a liability of the company. What if the company took a car loan? Well, we know the car would be the asset, but the loan would be the liability. And of course, if the company had a company credit card, or let's say the owner had a company credit card, the company credit card would be on the books and records as a liability, just like the bank account would be on the books and records as an asset. But remember, a liability can also be a future obligation to do something. For example, if a customer paid in advance before getting a product or a service, between the moment we got the money and the moment we give the product or service, our company books and records must reflect that we have this liability, a future obligation to pay, give, or do something. You probably already know that the three most important accounting words that we learn at the beginning are assets, liabilities, and owner's equity. But I think owner's equity deserves its own special video because all the other ideas of accounting come from the idea of owner's equity. So don't forget to tune in to the next video, What is Owner's Equity? A Conceptual Overview. I thank you for listening to my definition of these words. I know they're going to help you.
Chapter 4. What is owner's equity?
The textbook definition of owner's equity is the amount of ownership rights or ownership claim that someone has in an asset or even an entire business. In accounting, we can measure this in dollar amounts. The ideas are common sense and we deal with them all the time, every day. Any object or business can be owned by one or more people, and the idea is that there must be fairness or equality regarding the ownership. The textbook definition of owner's equity is the amount of ownership rights or ownership claim that someone has in an asset or even an entire business. In accounting, we can measure this in dollar amounts. The ideas are common sense and we deal with them all the time, every day. Any object or business can be owned by one or more people, and the idea is that there must be fairness or equality regarding the ownership. The idea is to share the value in a fair and equal way when there's more than one person that owns something. So, the accounting equation was derived by measuring the value of something like a car or a house or a company. All the assets of a company together have a value that you can measure. And the accounting equation created the idea of owner's equity when we assert that the value of these assets must be equal to who has a claim to the assets. So, if there's only one owner, the owner owns the entire ownership equity and owns the entire asset. But if there are several owners, we need a fair way to measure how much ownership claim or ownership rights is in the asset and how much each owner is entitled to have or use. So let's start with a simple example. Let's imagine that Sharon and Sally buy a car together. Now, if the car costs $1,000 and Sally only gives $600 towards the purchase price and Sharon pays the other $400, what would the ownership structure look like? Well, very simply put, Sally has 60% ownership claim or ownership rights in the car, and Sharon has 40% ownership claim or ownership rights in that very same car. So we could say that the car is equal to the value of who owns the car. Sally owns 60%, Sharon owns 40%, and we could say that Sally has 60% owner's equity in the car, and Sharon only has 40% owner's equity in the car. And you will notice that you know more about owner's equity than you realize. For example, question 1, can Sally tell Sharon that Sharon cannot use the car? Of course not. You know from your life experience that if you bought 40% of something and someone else owns 60%, you can still use it, and the person who paid more can't tell you that you could never use it. So that idea of owner's equity you already have. But what about this question? If they agree that they must paint the car only one color, they're not going to paint 60% of the car one color and 40% of the car the other color. They've already agreed they have to paint it only one color. Should it be the color that Sharon wants, or should it be the color that Sally wants? Well, common sense says, from your own life experience, if it's an either-or question about an asset that you share, the one that sacrificed more contributed more, and paid more is the one that gets the either-or question settled in their favor. So when it comes to painting the car one color, Sally would get the color that she wants. We all feel that's fair. Now, the car in that previous example was a metaphor for an entire company. In other words, all the assets together of one business can be owned jointly in the same way that Sally and Sharon share the car. Sally could be a 60% owner of an entire business. Sharon could be a 40% owner of that very same business. But when it comes to an either-or question, Sally would get what she wants, but Sally can't tell Sharon that she cannot participate. So these ideas about owner's equity come from common sense and fairness, and we experience them in our everyday life. Now, this second example will make it clear how owner's equity relates to the fundamental accounting equation. Let's imagine you want to buy a house, and the value of the house costs $100,000. And of course, we all know the house is an asset. Well, in order to buy the house, you would have to come up with a certain down payment from your own personal pocket, and you would have to take a mortgage for the rest of the money to buy the house. So you could say the value of the house, which is the asset, is equal to the liability that you owe for the house, which is the mortgage, and the down payment that you put in from your pocket, which is the equity that you invested yourself. So this is the same equation as it was with Sharon and Sally. But in this case, we have another type of claim against the value of the house. The mortgage is a debt claim, not an ownership claim like owner's equity, the way we were talking about Sharon and Sally before. But a debt claim is a certain type of claim against the rights and the usage and the ownership of the asset. So we know very well that if you had a restrictive mortgage, the bank has the right to tell you certain things. But the bank does not have the right to have their administrators come to your house at 2 o'clock in the morning and have a party, because that's not the type of ownership claim that they have. And we've experienced both of these types of claims in our lives, so we already have some sense on how they work. Now, clearly in this example, the house is a metaphor for an entire business. And what we've just derived right here in this video is the fundamental accounting equation. The assets of a house or an entire business must always be equal to the liabilities plus the owner's equity of that business. And in this case, the $100,000 house is equal to the $80,000 mortgage plus the $20,000 down payment that came from the owner's pocket. So we're going to put it up here as the fundamental accounting equation. And what you're going to see is that the accounting equation will always stay equal after each transaction. For example, let's imagine we pay $5,000 towards the mortgage for the purposes of decreasing the mortgage. Well, if we pay $5,000 towards the mortgage will decrease by $5,000. But that $5,000 did not come out of thin air. That $5,000 came from the owner's pocket. It means the owner took more of their personal money and put it into the house. If you take your personal money and you put it into an asset by investing in that asset or that business, you then have more owner's equity in that asset or that business. So if we pay the mortgage $5,000, the mortgage balance goes down, but the owner's equity, which is the amount we put in from our personal pocket, will increase. So the value of the house stays the same. It's still equal to $100,000. But now the balance of the mortgage has decreased to $75,000. But on the other hand, the total that we've invested in the house is now $25,000. The $20,000 was the down payment, and the additional $5,000 went to pay the mortgage so that we could keep the house. Now I've updated the balances, and let's try a second example. Let's imagine that we invest $10,000 to add a room to the house. Well, if you pay $10,000 more for physically more house, then the value of the house is going to increase by $10,000. But of course, that money did not come from the bank. That money is more money that we took from our personal pocket and put into the house. Therefore, the amount of owner's equity that we put into the house increases. The new value of the house is about $110,000 because we bought it for $100,000 and added a $10,000 room. But the amount prior to this that we had put into the house was $25,000. We now put another $10,000 of our personal money into the house. So the total that we've taken from our personal pocket and put into the house at this point is now $35,000. And because we paid for the room, the balance of the mortgage didn't change, which means the accounting equation stays equal after each transaction. Now let's apply this idea to an entire company. We're going to imagine that the house was a metaphor for all the assets together of a company. And let's imagine we're going to measure these transactions and record them in the fundamental accounting equation. Let's imagine that this company is starting out with $10,000 in cash, starting out with $20,000 of equipment that they paid for, and starting out with $5,000 worth of cars. Now let's also imagine that in order to own some of these assets, the company had to take a small bank loan. And if the bank loan only covered some of the cost of the assets, that means that the rest of the money for the assets must have come from the owner's pocket. So we're starting our little exercise with the assets on the left being equal to the liabilities and owner's equity on the right. And this company's accounting equation is equal at the beginning, and it will stay equal after each transaction. Let's imagine the company buys another car for $3,000 cash. Well, if we paid cash, then the amount of cash the company has goes down. But if we bought a car, the amount of car or the money value of the cars the company has will increase. So in this case, the new balance of cash after this transaction is $7,000, but the new balance of the cars that we have is now $8,000. And of course, all the other numbers in the equation did not change from this first transaction. So those balances will stay the same, and you will notice the equation stays equal after this transaction. Now here's an interesting one. Let's imagine the owner takes $5,000 of equipment that they were only using at home and brings that to the business to be used only for the business. Well, in that case, the business will have $5,000 more worth of equipment. But on the other hand, the business or the owner has $5,000 more of owner's equity in the business because the owner just took more asset value from their personal pocket and put it into the business. The new value or the new balance of the equipment is now $25,000, and now the new total that the owner invested is $25,000. And of course, because none of the other numbers changed for this particular transaction, the accounting equation stays equal after each transaction. Now let's do one more for good measure. Let's pay $2,000 to decrease the bank loan. Well, of course, if we pay to decrease the bank loan, we're paying money, so our cash will go down by $2,000. But because the reason we're paying the money is to decrease a bank loan, the bank loan will also go down by $2,000. The new amount of cash we have is only $5,000, but the new amount that we owe to the bank is down to $13,000. And again, because none of the other numbers changed during this transaction, the accounting equation stays equal.
Chapter 5. The origin of debits and credits.
We learned in the previous video that the assets of a company must be equal to the liabilities plus the owner's equity of that company. And we also learned that after each transaction, the equation must stay equal. But in the previous video, we recorded the transactions directly under the item name, as if we were adding them up and down in one column. The correct way to record transactions when we study accounting at the beginning is put them in things that look like this. These are the same numbers and the same asset balances on the left. These are the same liabilities and owner's equity balances on the right. And it is still the case that the assets equal the liabilities, except now the numbers are in their proper position inside something called a T account. Now a T account looks like the letter T, hence the term. And like everything else in the physical universe, a T account has a left side and a right side. Now, here's where the word debit and credit come into play. The word debit simply means left side. The original meaning of the word debit comes from Latin, and all it means is left or left side. And of course, the original meaning of the word credit comes from Latin, and it means right side or right-hand side or whatever you want to call it. That's all it means. All the other times you have used or heard those words spoken, they were being used as a metaphor from the original meaning from basic accounting. Now here's what makes it challenging. Sometimes we put the positive numbers on the debit side, but if it's a different type of account in a different accounting category, then instead we're going to put the positive numbers on the right side, the credit side. And of course, depending on the type of account, we might need to put the negative numbers on the debit side, which is the left side, but again, a different type of account in a different category would have the negative numbers listed on the right side, the credit side. So, we're going to record the same transactions as before, and they're going to be recorded in the same items with the same positive and negative numbers that we put before. The only difference is the numbers will be on the debit side and credit side instead of having a plus or minus in front of them. The most helpful way to think of the relationship between our fundamental accounting equation and the idea of debits and credits is as follows. Assets were presented in this equation on the left side. So you could think of them as normally being on the left side, which means they would normally have a debit side balance. And in the less frequent occasion where you have to put a minus to an asset, you would put that on the credit side of that asset's T account. And of course, for liabilities and equity, the idea is the same but the exact opposite. Since they're listed on the right side of our accounting equation, we could say that they normally have credit side balances. And in the rare occasion where we have to put a minus to one of these, we would put that on the debit side of that liability or that equity account. And this system will work perfectly so that after each transaction, the accounting equation will stay equal, but only if after each transaction the debits equal the credits. That's the reason why you have to make sure the debits equal the credits, because in the system that you're looking at, in this diagram, it will make it so that the fundamental accounting equation stays equal after each transaction. Now, we'll do the same transactions as before, except every transaction will change two accounts. One will be debit, the other will be credit, and the result will be exactly as it was before. Now, just like before, we're starting with a total of $35,000 in debit and starting with a total of $35,000 in credit, because the assets on the left are $35,000 and the liabilities plus equity are a total of $35,000, just like they were at the beginning of the previous video's transaction set. Now, Transaction A paid $3,000 cash for a new car. Now, which two accounts do you think would change? Well, if we paid cash, cash will change, and we probably have less cash if we paid. So cash will be minus, and since cash is an asset, the diagram tells us that we have to put that $3,000 as a minus to cash on the credit side, the right side of the cash account. But you can't make a credit without a debit. Now the transaction says the other account is the car, and car is an asset, and we have more car as a result. So if car is an asset and we have more, the diagram says we put the plus on the debit side. So for transaction A, the answer is cash credit and car debit $3,000, and the fundamental accounting equation stays equal. Now let's try transaction B. The owner invested $5,000 of equipment from his home to his business. Well, we did this exact transaction in the previous video where equipment went up, and the amount that this T account measures as the owner's investment in the company also went up because the owner invested more. We know that equipment is an asset, and if we have plus to an asset, the diagram tells us that we put that on the debit side. And if equipment is debit, and the transaction says the owner's investment is the other account, then the other account must be credit. The owner's investment is credit because the owner has more equity in the company because she or he invested more value in the form of the asset equipment. Transaction C is one that we also did in the previous video. Paid $2,000 to decrease the bank loan. Well, of course, if we paid cash, cash has less. And of course, if we paid down the bank loan has less. Well, cash is an asset, and the diagram says if the asset has less, we put that money amount on the credit side. So therefore, bank loan must be debit in this transaction. And you can see that bank loan is a liability. And we know if we pay to decrease the bank loan, that the liability should be debit the way that we just put here. Transaction D. Sold $4,000 of equipment for cash. Now, of course, this type of transaction is rare because we're not really in the business of selling equipment. But if we sold equipment and we got cash, it seems to me that equipment would go down because we sold some, and cash would go up because we just got some cash. They are both assets. So if cash goes up, cash should be debit, and if equipment goes down, equipment should be credit. So just to see that again in slow motion, the answer to D is equipment credit because we have less equipment, and cash debit because we have more cash. Transaction E. Owner took home a car that costs $1,000. Well, we had something like this in the previous video, or at least I think we did. First of all, if we took home a car, this T account is representing the business's money amount of car, not the owner. The business is a separate entity, and it is the business's T accounts that we're looking at. So the business has less car, and car is an asset, and it's decreasing. And if the owner is taking asset value out of the company, that means they invested less. So car must be credit because the business has less car, and car is an asset, and car is minus. So car will be credit. And if car is credit, the other account, owner's investment, must be debit because the owner has less investment in the company because they took out some asset. Transaction F borrowed $7,000 more from the bank. $7,000 more cash, that is. So cash will go up because we have more cash, but on the other hand, we owe more to the bank. And this T account represents what we owe. So cash is an asset, and because we have more cash, and cash is plus, cash is debit. If cash is debit, then the other account in the transaction, the bank loan, must be credit. Now, does it make sense to credit bank loan? Well, the bank loan is increasing, and a liability that's increasing gets a credit. So bank loan must be credit for transaction F for the $7,000. Therefore, cash must be debit. And finally, transaction G borrowed $6,000 more from the bank to buy a new car. Well, we know from a moment ago, if the bank loan goes up, that's a liability that's plus. So bank loan will be credit. And if we have more car, and car is an asset, car will be debit. So $6,000 credit the bank loan because we borrowed $6,000 more from the bank, and debit car $6,000 because we just got $6,000 more of a car. This is the idea of debits and credits. It comes from the fundamental accounting equation. And now that we're done, we're supposed to do what's called foot every account. That means take all the positive and negative numbers in each account and put them together, and whatever remains shows up as the ending balance. If the positive numbers for assets are more, that means you had more debit than credit, and you wind up with a debit balance. So if you did the math yourself, you will see cash has a debit balance of $16,000. If you take the equipment account and put all the positive and numbers together, put positive and negative numbers together, you will see that they are left over with positive $21,000. And since equipment is an asset, a positive balance goes on the debit side. Same thing with car. If you put everything together, you'll see that during this exercise, car had $13,000 more debits than it did credits. So it finishes with a $13,000 balance. How much do we owe the bank at the end? Well, we started with $15,000 and twice borrowed more, and that was listed on the credit side. And during this exercise, we only paid back $2,000. So if we tried to find out how much is left on the bank loan, we would see that we still owe $26,000. And because we still owe that money to the bank, it's listed on the credit side. Now, the owner's investment transactions are not really done exactly the way we showed it here. We only showed it for the main idea. But you can put together everything the owner put in and took out during the exercise to get the net result. So the net result of what the owner put into the business was $24,000. And now that we're finished, you could probably do a little bit more elementary school math, and you can see the ending total debits equal $50,000, and therefore the ending total credits must also be $50,000. That means the total assets are $50,000 and the total liabilities, and equity are also $50,000, and we did everything right. Chapter 6. A simplified three-step plan for debits and credits, presented by Serina May Jackson.
We're going to be working with 5 simple accounts. We're going to be working with cash, car, owner's investment, bank loan, and equipment. If it's an asset, then debit is plus and credit is minus. If it's a liabilities and equity, it's debit for minus and plus for credit. Every transaction changes 2 accounts. One account has to be debit and the other account is credit. Total debits and credits must be equal after every single transaction. Three-step plan. 1. Which 2 accounts change? 2. Is it plus or minus? 3. Look at the chart. Decide which ones are debit and which ones are credit. Transaction A. If you paid $3,000 for a new car, the accounts that will change are cash and car. Cash will be minus because you're giving away cash, and car will be plus because you're getting another car. So they're both assets, so car would be debit and cash will be credit. Transaction B. Owner invested $5,000 of equipment from his home into his business. So equipment will change and owner's investment. So the owner invested more into the job, so it's plus, and equipment is plus because the job's getting more. Equipment is an asset and it's plus, so it has to be debit, and owner's investment is an equity, so it has to be credit. Transaction C. Paid $2,000 to decrease the bank loan. So cash will change and bank loan will change. They're both minus because cash, you have less cash, but you decrease the bank loan too. Cash is an asset, and if it's minus, it has to be credit. Bank loan is a liability, so it has to be minus and it's credit. It's debit. Transaction D. Sold $4,000 of equipment for cash. Cash will go up and equipment will also change. So cash, you're getting more cash and your equipment is minus. Cash is an asset, so it has to be debit if it's plus. Equipment is also an asset, and if it's minus, it has to be a credit. Transaction E. Owner took home a car that cost $1,000. It's owner's investment and car. The company has less cars, so it's minus, and owner's investment is also minus. So car is an asset, so and it's minus, so it has to be on the credit side. Owner's investment is an equity, so it has to be on the debit side if it's a minus. Transaction F. Borrowed $7,000 more from the bank. Bank loan will go up and cash will go up because you have more of a bank loan because you're getting you have more, so eventually you have to pay back the money, and cash goes up because you have more cash. Cash is an asset and it's plus, so it has to be a debit. Bank loan is also a plus and it's a liability, so it has to be credit. Section G. Borrowed $6,000 more from the bank to buy a new car. Car and bank loan will change because you have more of a bank loan because you borrowed more, so you had to pay back the bank even more. And car is also plus because you have another car. Car is an asset and it's plus, so it has to be debit. Bank loan is a liability, so if it's plus, it has to be credit.
By the way, folks, Serina really does know her debits and credits. And if you would like to see the footage of Serina learning her debits and credits, you can vote yes in the survey that's coming at the end of the video. You could also leave a comment or send me a message on this very website. And by the way, please mention if you think this is a good intro to the videos. Hi, I'm Uncle Mark.
And hi, I'm Serina May Jackson.
Okay, and this is the Debits and Credits Show. Learn your debits and your credits, learn your debits and your credits, learn your debits and your credits today. Learn your debits and your credits, learn your debits and your credits, learn your debits and your credits today. Chapter 7. Empowering Definitions. Knowing the crucial words that will help you really understand accounting. First definition we will learn is income from service. It's a T account that we use to record each event when we earned income from a service. A service income is money you earn for doing what you normally do in business. Of course, you don't only have to have a service business, you could have a merchandise business. And you would earn income in a merchandise business at the moment you deliver the merchandise to the customer. You earn income in a service business at the moment you deliver the service. There's one T account that you should record all the income, which means all the money that comes in from that particular service. And it's very easy to record it in the T account. Income will only be credit, never debit. That means if you're recording income and you record each event where you've done a service and earned income, you should see transactions listed only on the right side, the credit side, because that's the way it goes. And I'm going to show you the reason for that a little later in this video. And now I will introduce you to a very important account when we study accounting. This account is called Accounts Receivable. Accounts Receivable is the total money that all customers owe you for selling them stuff or doing stuff for them, like the income that we mentioned a moment ago. If Alan owes you $30 for delivering a service in the past, and Betty owes you $40, and another customer, Candy, owes you $50, then in that case, the balance of accounts receivable, the T account, at this moment should equal $120. That's the reason for it. It equals the total balances of all customers at any given moment. So, accounts receivable is an asset because it represents money that you will receive in the future. And as you know, assets are plus for debit and minus for credit. That means if a transaction requires that you write down you will receive more in the future, you'll put that on the debit side. But if you will receive less in the future as a result of a specific transaction, then that transaction would be listed on the credit side. So if we take a look at an example, if Alan did a service if we did a service and Alan promised to pay in the future, well, that means you will receive more in the future. So the account receivable account will be debit because it's plus. You will receive more in the future. And of course, the other account will be credit. And in this case, like usual, it'll always be income credit. Now, what about this? We did a service for a different customer. Even though we did a service for a different customer, it should still be debit for accounts receivable because that customer promised to pay in the future. So the total money that we will receive from all customers in the future will be more as a result of transaction B. So transaction B is debit. However, if we have a transaction that requires that we decrease accounts receivable because the transaction means that we will receive less in the future as a result of that transaction, then we would have to make a credit. So if one of the previous customers who owed money pays some of the money, that would be accounts receivable credit because we will receive less in the future. So even if a different customer paid, any customer who pays, we have to make a credit to accounts receivable and a debit to the other account involved in the transaction. Usually cash because we got more cash. But this is how accounts receivable behaves, and it will be matched to each individual customer's balance so that the total of each individual customer's balance will always equal the balance of this T account, accounts receivable. Now, most people already know the definition of this next word, expenses. You could think of them as the opposite of the first definition that we learned in this video. Expenses are like the opposite of income. Income is money that we earn for performing a service. Expenses are money or monies that we must pay to be able to earn the income. If we don't need to pay the money in order to be able to earn income, then it's not a valid business expense. And of course, we would not write down all the expenses in only one T account. If we needed to pay for delivery in order to earn income from our customer, we would record all of the deliveries and only the deliveries in a T account called delivery expense. If we had to pay for repair in order to service a customer, we would record all of the repairs, or rather each time that we paid for a repair, we would record that instead into this account, repair expense. And expenses are only debit, never credit. So if you are recording your expenses and you look at any of your expense T accounts in your general ledger or your chart of accounts, you will see only transactions listed on the left side, never on the right side, because expenses are only debit, never credit. Remember, expenses are like the opposite of income. And earlier we learned that income is only credit, never debit. So expenses are only debit, never credit, and I'm going to explain why at the end of this video. And just like expenses are the opposite of income, accounts payable is the mirror opposite of accounts receivable. Accounts payable is a T account. It is a liability, and it represents the total money that your business owes to people or companies who did a service for you. For example, if you owe Rex Repair Shop $30 for a repair service, or you owe FedEx $40 for a delivery service, then that means the balance in the T account, accounts payable, should equal $70. It represents the total money that you owe to all vendors at any given moment. Accounts payable is a liability. That means that it's minus for debit and plus for credit. So, If we have a transaction that requires us to increase what we will pay in the future, then we will make a credit to account payable. Even if that transaction is from a different vendor, we will still make a credit to account payable and a debit to the other account, usually an expense like a service that we received from a vendor. Of course, if we record a transaction that reflects the fact that we owe less to our vendors in the future, then for that transaction we would make a debit because we would pay less in the future as a result of that transaction. Of course, the other account involved would be a credit, usually cash, if we're paying off some of our vendors. So that's the way accounts payable would behave in the general ledger when you record your debits and credits. And finally, I will clarify the proper way that owner's equity transactions should be recorded. They should not be recorded the way I demonstrated in previous videos. Of course, we don't have only one T account to represent the entire category of owner's equity. I only showed it that way before just for you to get the idea. The real truth is that there are two separate owner's equity accounts. One is called owner's capital and the other is called owner's withdrawals. Owner's capital is the T account where we record the owner's equity transaction when the owner invests any asset, cash or equipment or anything. When the owner invests any asset, we record that only in the T account capital. And we always make a credit because capital is always plus to owner's equity because all it represents is what the owner put into the business from his or her personal pocket. So that's why capital is always a credit, never a debit. Now the exact opposite of that account is the one right here on the left, withdrawals. This account will record any time the owner takes out any asset from the business, whether the owner withdraws cash, equipment, or anything the owner removes from the business to be used for non-business reasons would get recorded in this account on the left, owner's withdrawals. And every time the owner withdraws any asset from the business, the owner has less owner's equity. So withdrawals is always minus to owner's equity, and therefore you have to make a debit every time the owner withdraws money or asset from the business. In fact, you could even say that withdrawals is always debit, never credit. Now, in closing, you should know that owner's capital and owner's withdrawals are not the only accounts under the category of owner's equity. The other two accounts under the category of owner's equity are the two accounts that we learned about right here in this video. Both expenses and income are also technically under the category of owner's equity. That's because expenses always make owner's equity go down because the person responsible for the expense is the owner. And income always makes owner's equity go up because if a customer gives money to the business, it's the owner's money that the customer is giving after the sale or after the service. So these four accounts are technically under the category of owner's equity, and they make debits and credits very easy. I hope that you will use your accounting textbook to understand a little bit better why these accounts are under the category of owner's equity. But if you have a transaction with any of them, you should always know what to debit and what to credit. If one of the two accounts in your transaction is either withdrawals or an expense, you will have to debit the withdrawals or expense and credit the other account. If your transaction requires that you use the owner's capital account or the income account, then you know for sure you're going to make a credit to either income or capital, and the other account in the transaction should be debit. So now your adventure of debits and credits should actually be easier by understanding the meaning of these four items under owner's equity. Chapter 8. It's time for more advanced debits and credits with our friend Serina Mae Jackson.
These are the accounts that we used in last video. We are going to be adding video income, accounts receivable, delivery expense, repair expense, accounts payable, owner's capital, and withdrawals. If it says no, then you cannot record a transaction on that side. Transaction A. We did a service for customer Alan for $100. He promised to pay in the future. Accounts receivable changes because we can receive money, and video income changes because we did a service. If there's a no X on the debit side, it has to be credit. And if video income is credit, accounts receivable is debit. Transaction B. Rex Repair Shop did a repair service for us. We promised to pay him $85. So it's accounts payable and repair expense. Repair expense has a no X on the credit side, so it has to be debit. And if repair expense is debit, accounts payable has to be credit. Transaction C. Did a service for Betty and she paid us immediately with cash, $95. So, service income changes and cash, because cash changes because she immediately paid us, so we're getting more cash, and service income because we did a service for her. If service income cannot be debit and it has an X on the debit, it has to be credit. And if service income is credit, cash is debit.
Boom.
Action D. Paid FedEx immediately with 7-day, $75 cash for a delivery today. So delivery expense and cash. Delivery expense has a no X on the credit side, so it has to be debit. And if delivery expense is debit, cash has to be credit. Transaction E. Owner withdrew $28 cash from the business. So, cash will change, and I think withdrawals.
Correct.
Because, cash will, withdrawals has an X on the credit, so it can't be credit. So withdrawals is debit. If withdrawals is debit, then cash must be credit. Question F. Alan paid us half of what he owed us from transaction A. So cash will go up because we got more cash, and accounts receivable because we received half of what was in transaction A. So accounts receivable and cash, neither of them have an X, so we don't know immediately which one is which one is debit and which one's credit. So cash, you're getting more cash, so you would get plus, and it's an asset, so plus is this side, and accounts receivable, it's you have only 50 left to go, and you got half of what was in transaction A, so accounts receivable is an asset too, and it's minus, so it has to be credit. Action G. We pay Rex Repair Shop only $65 of what we owe for transaction.
Oh, I meant to do B. I meant to say transaction.
B. Well, if it was $85 and we paid $65, we still have a little bit left over. Accounts payable and cash will change. Neither of these have an X on any side, so again, we don't know immediately. So cash, we have less cash, and it's an asset, and it's minus, so it has to be on the credit side. Accounts payable is a liability, and if it's minus, it has to be a debit. Transaction H. Owner brought $700 worth of equipment from his home into the business. Equipment will change and owner's capital will change. Equipment will change because the company has more equipment, and owner's capital will change because the company, the owner is giving more equipment.
Mm-hmm.
So equipment is an asset and it's plus, so it has to be debit. Owner's capital is also plus, but it's an equity, so it has to be credit. Transaction J. Instead of paying cash, we gave the bank $300 of equipment to decrease the bank loan. So bank loan will change and equipment will change. So bank loan will change because you're decreasing the bank loan, and equipment will change because you have less equipment. So bank loan is minus and it's a liability, so it has to be debit. Equipment is also minus and it's an asset, so it has to be credit. It doesn't have to be one account debit and the other account is credit, as long as total debits and credits equal each other after each transaction. Okay, the service for customer candy was $200. She paid $50 cash and promised to pay $150 later. So service income is $200, cash is $50, and accounts receivable is $150.
And what are the debits and credits?
So the service income has a no X on the debit, so it has to be credit. Accounts receivable is plus because it's an asset, and plus is debit, so it's debit. And cash is also plus, and it's also an asset, so it has to be debit also. Transaction L. Rex did a repair service for us worth $130. We paid only $30 now and promised to pay the rest later. So it's accounts payable, repair expense, and cash. So cash changes because we paid $30, so we're giving away money. Accounts payable because we can pay $100 later. And repair expense because we have to pay an amount of money.
By the way, folks, Serina really does know her debits and credits. And if you would like to see the footage of Serina learning her debits and credits, you can vote yes in the survey that's coming at the end of the video. You could also leave a comment or send me a message on this very website. And by the way, please mention if you think this is a good intro to the videos.
Hi, I'm Uncle Mark.
And hi, I'm Serina May Jackson.
And this is the Debits and Credits Show. Learn your debits and your credits, learn your debits and your credits, learn your debits and your credits today. Learn your debits and your credits, learn your debits and your credits, learn your debits and your credits today.
Chapter 9. The Full Accounting Cycle. Do you remember from the prior video how we found the results of each of these accounts? We got the total debits and total credits and put them together, and the result we put on only one side. Well, what was that process and how is it done? That process is called footing the accounts. And footing the accounts means find the total debits, find the total credits, put them together, and find the ending balance. For example, let's imagine we have a T account for cash or some asset, and every time you had a plus to cash, you put it on the debit side, and every time you had a minus to cash, you put it on the credit side. Then during the month, you accumulated transactions. Well, how could you know your result at the end? What you would do is you would take the total of the credits, and then you would take the total of the debits, and then you would combine them. For example, this account has a total of $25 in credits, and it has a total of $60 in debits. So the debits in this case are more than the credits, so the account will finish with a debit balance when you subtract the two. That debit balance is the ending balance, and that's the number that would begin the balance of the account starting in the next month. You would use the same procedures to foot an account that has the opposite behavior, like a liability. We all know that the bank loan is minus for debit and plus for credit. So if you borrowed money, you'd put it on the credit side. If you paid off money, you put it on the debit side, and so on. At the end of the month, the T account bank loan would have a balance that you would have to find out. You would do the exact same procedure. You would find the total credits, you would find the total debits, and in this case, the credits are slightly more than the debits. So that when you combine the debits and credits, the resulting number goes on the side of the higher one. So in this case, the bank loan is going to finish with a $5 credit balance, and that will be the number that the T account begins with at the beginning of the next month. Now, in the days before the computer, we did not use accounts that look like a T. In real-life accounting, in the old days, this is the way the accounts looked. The T account would not show you the balance after each transaction, and it didn't really have a space to put in all the information across the row about each transaction. So the accounts really looked like this. And if you had a transaction that made the balance go up, you would simply add it. If you had a transaction that made the balance go down, you would simply subtract. This way, you would know the balance after each transaction, and you would also know the balance at any given moment in time. For example, you can see that September 17th, we owed $75. But if I asked you, how much did we owe exactly on September 12th? Well, September 12th is not listed in the date column. So you would go back to the last transaction before September 12th, find that balance, and then you would know the balance on a particular day and time. Using the accounts like this helped bookkeepers record more detail and keep more accurate track of the balance. And when the accountant would come in to find the results at the end of the month, the accountant would simply know bank loan is a liability and this $5 is a credit balance. Now, footing the accounts was only the first step in the process of finding the results at the end of each month. After you found the results, you would put the ending balance of each account in a report called the trial balance. The trial balance is a report that shows the results of all accounts. And if the account had a debit balance, it would be listed on the debit side of the trial balance. And if an account had a credit balance, it would be listed on the credit side of the trial balance. And as you can see, the trial balance would give you some information about how your business is operating. But this data, when it's in the trial balance, is in its raw form. You were not finished when you made a trial balance. But one of the reasons you made the trial balance is to make sure that the debits equal the credits after the entire process of recording the transactions, putting them in the T accounts, finding the balances, and putting the balances up in the trial balance. We came up with this system of debits and credits thousands of years ago to make sure that we did not make any mistakes when recording transactions or doing the math to find the results. Remember, accounting procedures were derived in the days before the computer. And although you can see some things about the business operation simply by looking at the trial balance, you would gain better insights into what is happening with the business if you took the numbers from the trial balance and reorganized them into documents called financial statements. And I'm sure you've all heard the names of the typical common financial statements. These are the documents that we look at in order to make a judgment about how well the business is doing and to make certain business decisions. By taking the numbers from the trial balance and organizing them into these financial statements, the numbers present a more clear picture of what's going on in the business. Now, in the days before the computer, the T accounts were not the original books of entry. Instead, you had something called the General Journal. And if you wanted to record transactions here, you needed to know your debits and your credits. That's because the transactions would first be recorded in the journal. And when you record transactions in the journal, you would write down which account will be debit and which account will be credit. Then later, you would do what's called posting. That means copying each transaction from the journal to its appropriate T account and putting in the appropriate debit and credit. You would not post after each transaction. The whole point of the journal would be to record everything on one paper to save time. Then, at the end of the time period, when you wanted to assess your results, you would post all the debits and credits into the T accounts. And if you did that correctly, the results in the T accounts would be the same as if you put the numbers in there directly, like we did earlier. Then, of course, you would foot the results of the T accounts, and then again take the ending balance of each account and put it in the trial balance. So now you know the accounting cycle perfectly. We start with transactions that we would record in the general journal. Then we would post from the journal to the T accounts that we have been working with. Then we would foot the T accounts and put those results in a report called the trial balance. And then, of course, we would take the numbers from the trial balance and put them on financial statements so people can look at those documents and understand what's going on with that business. Chapter 10. Now let's see some example of journal entries and how it looks when we use the computer. We remember the accounting cycle in the days before the computer involved several steps before we could find our accumulated totals in the trial balance. Now, with the computer, we can go directly from the journal and it will automatically post the transactions, foot the accounts, and copy the results to the trial balance in a split second. So all those previous steps we learned about in the prior video happen immediately. So all we have to do is record the transaction in the journal and the results change in the trial balance like that. So if you are using QuickBooks Online, this is the window that you would enter the transaction in. And then the accounts would change immediately in your QuickBooks Online trial balance. And I'm going to demonstrate this in QuickBooks Online. If you're using QuickBooks Desktop, this would be the window that you would record the debits and credits of a journal entry. And again, in QuickBooks Desktop, the results in the trial balance would be updated immediately. So first, we will do these transactions with QuickBooks Desktop, and we will do the same transactions as before. Let's get prepared. I have my QuickBooks Desktop with a blank General Company open. And for those of you who are new to QuickBooks, you would open the trial balance by clicking Reports, Accountant and Taxes, Trial Balance. And for those of you who are new to my class, we always change the date range to all transactions regardless of date. And I'm going to change the shape so we can put it here and put next to this window the window that we actually record the journal entries in. From the main menu, click Company, Make Journal Entry. And then this little pop-up, don't worry about assigning numbers, just click the Don't Bother Me box and click OK. Now you can't see much of this window unless you double-click the words in the ribbon to collapse the ribbon. Now the top half looks a little bit more like the general journal that we learned about. And let's read our transactions, and remember, as soon as we record the transaction in the journal, it will automatically post the accumulated results to the trial balance. Now, let's do the same transactions that we did earlier in the course, except now we'll do them on QuickBooks. Let's imagine on January 1 of 2025, the owner invested $50,000 cash into the business. If you learned your debits and credits properly, you would know that that would be $50,000 cash debit and $50,000 owner's capital credit. First, we put in the correct date by clicking the date box and going forward or backward, or even typing it in manually. You should remove this check mark because this is not an adjusting entry. We will talk about those a little bit later. To record a journal entry in QuickBooks Desktop, click directly under the word Account. Then click the pull-down arrow and choose the account you want to debit. I choose Cash in Chase Bank, and on the same row as that account, I click under the word Debit and type in the $50,000. If I keep clicking Tab or pushing the Tab key, you will see that most software finishes the journal entry for you by trying to balance it out. In other words, QuickBooks knows that there has to be a $50,000 credit somewhere, and that account is owner's capital. So this is the way that debit and credit would look like in the general journal. Cash and bank debit, owner's capital credit. Now before we save it, the trial balance is blank. But when I click Save and Close, you can see the numbers show up for the first time on the trial balance: cash in Chase Bank $50,000 and owner's capital $50,000. Now let's imagine that on January 5th, we pay $20,000 more for more equipment. If you studied your debits and credits properly, that would be equipment debit and cash credit. So, company, make general journal entry. Okay, the date is January 5th of 2025. This is our second entry. It's not an adjusting entry, and the account that will be debit will be equipment, and the amount will be $20,000. Keep pushing the tab key, and the credit, or in the row of credit, the other account is cash, because we know that if we pay cash and get equipment, it's equipment debit, cash credit. Now, here's the question. What will the results be after I save this transaction? Well, cash right now is $50,000. So if I make a credit of $20,000, what do you think the result would be? That's right. The result would be $30,000. What about this? What do you think the equipment would be? Well, equipment is starting at 0. So if I save this, equipment should show up for the first time as $20,000. Save and close, and don't worry about this, just click the Don't Bother Me box. Click OK. Aha! Cash went down to $30,000, exactly as we expected, and equipment showed up in the trial balance for the first time as $20,000. What about this one? January 10. The owner took home equipment worth $5,000 and he's not using it for business anymore. Well, if you studied your debits and credits, you would know that that would be equipment credit and owner's withdrawals debit. Again, we click Company, Make General Journal Entry. In this case, the date is on the 10th, and this is our third such journal entry. I'm going to double click here so we can see it nicely. And now I'm going to choose Owner's Withdrawals Debit and put in the row of debit 5,000. And I'm going to tab over until it puts a credit of 5,000, and I'm going to credit equipment. Now, here's the question. Can you predict the results? What will equipment become? Well, equipment right now is 20,000. So if we're decreasing it by 5,000, it should become 15,000 if we did this right. And what will withdrawals become? Well, withdrawals will show up for the first time here as 5,000. Save and close. Aha! Equipment is down to 15,000 and owner's withdrawals is 5,000 on the debit side. It means we recorded the transaction correctly. What about this one? January 15th, we borrowed $35,000 from the bank. What will cash become? Well, right now, cash is only $30,000. So if we borrow more from the bank, we'll have more cash. So if we record this transaction properly, cash and bank will become $65,000. And bank loan will show up for the first time in the trial balance. So we change the date to the 15th, and we make a debit to cash and bank for the $35,000, because we learned that when cash increases, it's a debit. And the balancing credit is here, bank loan. And when I click Save and Close, the numbers are exactly as we expected. Cash becomes $65,000, and bank loan shows up for the first time as $35,000. Now we'll do a transaction that would absolutely require a journal entry. What if on January 20, the owner invested a vehicle worth $25,000 into the business? What would be debit and what would be credit? Well, we know capital would be credit because the owner invested an asset. And capital right now has a credit balance of $50,000. So if the owner invests another $25,000 in asset, that's right. Capital will become $75,000 and vehicle will show up for the first time in the trial balance. So, from the main menu, Company Make Journal Entry, this time the date is January 20. And the account that's debit is the new asset that we are getting, vehicle. And we said that the vehicles are $25,000, or at least they're worth $25,000 at the moment the owner invests it into the company. And because the asset came from the owner now has more capital, and we make a credit to capital to increase the owner's capital. When we click Save and Close, capital became the number that we expected it to become, and therefore we recorded the journal entry properly. Now here's one that you might not need to make a journal entry for, but it is one we learned before. $3,000 to decrease the bank loan. Well, if this account represents what the bank loan is now and what we owe, if we decrease it, what will it become if we record this properly? It should become $32,000. And what will cash become? Well, if we pay to decrease the bank loan, cash will decrease by $3,000, and it will become $62,000. So we're up to January 25th, and we know that it will be cash credit because we are giving cash. So cash and Chase Bank credit by the $3,000. And we know that we're decreasing the bank loan, and the bank loan is a liability, so it will be bank loan debit. Now when we click Save and Close, the results are exactly as what we expected. The bank loan became $32,000 and cash in bank became $62,000. Let's finish with a transaction that you would definitely need to make a journal entry for. Let's imagine on January 27th we borrowed $17,000 more from the bank and bought equipment. That would be the same thing as just taking the equipment and assuming a loan. In that case, you have more equipment, but you also have a higher balance or more of a bank loan. So we know that would be equipment debit and bank loan credit. So, company make journal entry, and this one is on January 30th, and it will be equipment debit for the $17,000, and it will be bank loan credit. Can you predict what the results will be? Well, let's see. If equipment goes up, if bank loan goes up by $17,000, bank loan should become $49,000 because bank loan is $32,000 right now. And if equipment goes up by $17,000, equipment should become $32,000 because these are the numbers for equipment and bank loan before I click Save. And when I click Save and Close, you can see the numbers are exactly as what we predicted. Bank loan is $49,000 and equipment is $32,000. Don't forget to watch the QuickBooks Online version of this video. Chapter 11. Now let's practice what we've learned about journal entries, debits, and credits. This service business transaction practice set is literally just like an Accounting 101 textbook practice exercise. You have to set up the T accounts on something you can write on. In the old days, we would use a paper and a pen or pencil, but of course you could use Word or Excel or anything else. What you will do is after you make the T accounts, you'll record the transactions that I give you, and you'll compare your results to mine. If they're different, you will use logic to find and fix mistakes, and I'm going to give you some logical tips that will always help you find and fix mistakes after you're done recording transactions in accounting. So, what are the specific instructions of this project? First, create a T account for each of the accounts on the account list in the given chart of accounts. 2. Record all transactions from the transaction list to the T accounts that I have provided for you. 3. Find the balance of each account after you're done recording all the transactions, and then make a list of all the account balances, and that list is something called the trial balance. Then, once you have your trial balance, you can compare your results to mine and use logic to find and fix mistakes. And don't worry about a thing, because everything you physically need to do this project is inside the downloadable Excel file that I have put in the resource tab of this video. Just download it, open it up, and follow the steps. You can easily access the files for all of these projects by clicking Show More, just like you did before to reveal the table of contents. But if you look all the way down at the very bottom of the description field, you will see that there are links to each of the project sheets for each of the projects. And if you just click on any one of the links to download them, all you have to do is click where the link is for this particular exercise, and you should be given an option to choose which folder to download the file to. In this Excel spreadsheet that you will use for this project, there is one particular sheet with a T account for every account in this list of accounts, which is also called the chart of accounts. And it is those T accounts that you will record the transactions into. Now, also in the sheet is this list of transactions. You should record every debit and every credit in proper order using this list. Go slowly and record it exactly as you saw us record each of these transactions in the lectures where I gave you similar examples. And record them in the T accounts that you either draw on a pencil and piece of paper, or record them in the T accounts that are provided in the Excel sheet. Now, in order to use this Excel sheet, you don't need to know any Excel at all. Just type in the numbers you want, and Excel will automatically add them for you. It's just a simple convenience. But if you're having any trouble at all, just use a pen and paper. So if you download the file and you open it up, you would click down here to get the different sheets. And if you can't see all the sheets, you would scroll right and scroll left. The leftmost sheet are the general instructions. The next sheet is the list of transactions that you will record. The next sheet are the T accounts. And if you don't know Excel, watch carefully how they work. If you're going to make a debit to an account, you should click in the top left and put just the date and hit Enter, and Excel will record the date. Then click next to it, just like we showed in the video, and put the money amount, type it in, and to save it in the field, push Enter, and notice Excel will add it for you. If you want to make a credit, put the date in the rightmost column, hit Enter. Then on the inside, type the money amount, hit Enter, and Excel will add it for you. If you need to make a second transaction, go to the next line and do the same thing. Soon as you hit Enter, it will automatically add the column so that you don't have to do any math, and the numbers will stay nice and neat, and you will save huge amounts of time putting in your debits and credits. When you finish putting in your debits and credits, you will see that there is a sheet provided for you to make a list of every remaining debit balance and credit balance for each of the T accounts that you were using during the transaction set. Try to put the list of the final balances into that sheet and make it look like this. Excel will add and do the math for you. Now, the name of this report that you're constructing when you finish putting in all the ending balances, which are the results of all transactions, this report is called the trial balance. And the trial balance was a very important report for both the bookkeepers and the accountants in the days before the computer. You see, the trial balance is a list of ending balances of the chart of accounts after a specific period of time, usually some accounting period like after 1 month or after 1 fiscal quarter, where you would stop and assess everything. The account balances must be separated into debit and credit columns so that you can see if it's a debit balance at the end or a credit balance at the end while reading the accounts from the list. So, the reason to make this is to be sure that you have not made any mathematical mistake before putting these numbers on your formal financial statements. If the debits equal the credits, then there is no mathematical mistake. So, if there's still a mistake, even though there's not a mathematical mistake, you have to use logic and use the logical steps and the logical thinking that you're about to learn here to fix the differences and to make your final numbers the same as mine. First, you have to ask yourself if you finished with any number that's different than what it shows in the answer. Ask yourself, what specific account balances are different? Just by isolating those two, you'll be able to also hone in on how much they are different by. And by thinking of which specific accounts are different and how much they're different by, you should then also consider which account is too high and which account is too low. Thinking about all these things will help you focus on what were the only transactions that were recorded in only those accounts. The mistake must be from one of those transactions. So if you know which specific transactions change these specific accounts, or which specific transactions are the money amount of the amount that's too high or too low, or which specific transactions are of the money amount that the wrong accounts are different by, you can use logic to fix the mistake. Check any transactions you put into only those accounts, or maybe should have put into those accounts when considering what mistakes you could have made. For example, if cash in the bank is too high and accounts receivable is too low, what could be the only reasons that those would be the only two accounts that are different? Well, if you give yourself a moment to think about it, it could be that if you recorded receiving cash for a service of a sale rather than recording it in account receivable, that's something that might make cash too high and accounts receivable too low. So you might want to double check any transaction where you were doing a service for a customer. Or what if you recorded receiving a payment from a past service twice? If you duplicated an entry and you duplicated both the debit and the credit, they would still balance in the trial balance, but the individual numbers of the accounts would be different. Find out which specific accounts are different and see if they have any duplicate entries in them. Also, look at the money amounts to determine the mistakes. It's very rare that you would have two mistakes in one account. So if you know how much a difference is in one particular account, you know that you can look back on the transaction list and find the transaction with that specific money amount, and there's your mistake. So, have confidence that you will find whatever mistake you might have made. Don't peek at the answers until you absolutely must. Good luck doing the exercise, and please stay in touch and give me feedback about how well you did and how you felt it might have helped you learn. Thank you again, and I'll see you in the next video. Thank you so much for learning this with us. There's more great stuff to come, and remember, you have the benefit of a live teacher if you ask me your questions in the comments section below. And don't forget to click like and subscribe to help support the free channel that helps everyone.
Part 3. End of Cycle Procedures.
Chapter 12. End of Period Accounting Adjustments. Adjustments are journal entries that we make periodically to correct our financial records for the passage of time. It also helps us prepare for financial reporting by acknowledging the cutoff dates of certain amounts. We also make adjustments to correct for mistakes, and we usually make them monthly or immediately before reporting our financial statements to someone because we want to adjust our general ledger to make sure our financial statements are accurate. The idea behind this is that assets and expenses are really the same thing. Think about the definition of expense. It's when you pay for something after you use the value of whatever service that you're paying for. Things like salary expense, repair expense, utilities expense, delivery expense. Usually you pay for them before you use them, and of course we always think of them as expenses. But assets are something you pay for before you use the value. For example, a car. Usually you buy the car before you can drive it and use the value of the car. So we always think of car as an asset. What about furniture? Usually you buy the furniture. You don't sit on it for 5 years and then when it breaks, you pay the person you took it from. Usually you pay for it first, which means assets are paid for before you use up the value of whatever you need them for. But what about things like rent, insurance, and supplies? We usually think of these things as expenses, and they are. But these things, we usually pay for them before we use them. So even though we think of them as expenses, technically, at the moment we pay for them, they are assets, and they become expenses as we use them. So therefore, if at the moment you pay for something, it still has value you can use into the future, you just paid for an asset. But if at the moment you pay for something, you have already used the value, or you could say you have already expended the value, then at that moment you have an expense. And if it was an asset, don't worry. Wait a little while and you will finish using the value, and the amount you use, let's say the amount you expend, will become the amount you record as the expense. For example, supplies. You always pay for them before you finish using them. Then over time, you use some supplies, and the amount of supplies you have used, the amount of supplies you have expended, then gets recorded as supplies expense. Now this idea is also the same for paying office rent. You usually pay office rent in advance of staying in the office. So technically, at the moment you pay the rent, you have an asset. You have something of value that you can use into the future. You have the ability to stay in the office. But over time, as you stay in the office, the amount of time that you've used or expended becomes your real rent expense, and that's the amount you record on your income statement for that month as rent expense. Insurance is the same thing. You always pay insurance in advance of the time in which they protect you. Then over time, you're using the coverage and your coverage is elapsing. After you've used a certain amount of time during the policy, the amount of time of the policy that has elapsed is your insurance expense, and the remaining amount still stays on your books as an asset. So let's see how this would work. Let's imagine on January 1, Holden, the owner of the company, paid Staples $700 for supplies. Well, on January 1, we did not finish using the supplies, so we cannot record this into supplies expense. On January 1, we have a new asset, and just like we did in previous videos, we make a debit to the asset for the amount that we paid. Of course, cash is credit if we paid cash, but we're not really focusing on cash right now. We're just focusing on the asset that we bought that we will use into the future. Now, the most important date is January 31. Let's imagine it's 1 month later, and we physically count the supplies, and we see we only have $300 worth of supplies left. Well, the first question is, how much of supplies did we use? Obviously, we used $400. You could also say we expended $400 worth of supplies during January. And that means supplies expense should be debited $400 for the amount that we actually used during January. And that $400 will go on the income statement, profit and loss, as supplies expense for the month of January. Now, of course, if we made a debit to supplies for $400, we have to make a credit of $400. We credit the asset if the value is going down. And of course, it is correct to credit supplies for the $400 so that the ending balance of supplies at the end of the month truly reflects what we physically have. We physically have $300 worth of supplies, and as you can see, that's the new ending balance. The supplies expense account is an expense, so that will get closed at the end of the month so that you can measure more, starting from zero, how much supplies you used in the next month. So you will see in the following videos, expenses become zero after each period so that you can start counting fresh what you used in the next month. But this $300 remaining in supplies goes up top as the beginning balance on February 1 for the asset account supplies. Now that idea will help you understand a special type of asset called prepaid expenses. These are time-based expenses, things that we use just because of the passage of time. Time-based expenses are things like rent when we pay office rent, or insurance, something we pay that we will use in the future, but we would normally consider it an expense. For example, let's imagine on January 1, Holden, the owner, paid Farmers Insurance $1,200 for the whole year's office insurance. Now, we know that the office insurance is only really $100 per month. We're really only using the value of what we paid at the rate of $100 per month. Now, you can put the whole $1,200 into the insurance expense account if you only report once a year. So if you don't need to show anyone your financial records until December 31, it really wouldn't matter if you put this into insurance expense at the beginning. However, if you need to report monthly financial statements, you must put the $1,200 into an asset called prepaid insurance and then adjust it each month, just the way you saw in the previous example with supplies. Prepaid insurance is another current asset type of account. So what's the difference? Why can't I just put insurance in insurance expense when I pay, or rent into rent expense when I pay? Well, let's think about it. If you recorded this the wrong way, and it all goes into insurance expense when you write the check, that means January's income statement is going to list insurance expense as $1,200 because that's what you paid in insurance for January. In February, you didn't pay anything for insurance, so on February's income statement, insurance expense will be listed as zero. March's income statement, insurance expense will be listed as zero, and so on. Do you think you can fairly and reasonably compare your operations between January and February by comparing January's income statement to February's income statement? Of course not. You cannot compare them in a fair way because you recorded all of the year's insurance as an expense for January and none for February. So January and February's profit and loss statement cannot be compared in an accurate and fair way. But if you do it the right way and adjust it the way I'm about to show you, then January's insurance expense will be only what you used during January, and February's insurance expense will be only what you used during February, and so on. This way, you can properly compare January's income statement to February's income statement and make a fair and clear judgment about the difference in how well you did each month, because now it shows the real amount of insurance expense that your company is using each month. So how do you actually do this so it comes out correct? Well, when you pay the insurance, put the money into the account called prepaid insurance, which is another current asset like supplies. Then make a journal entry to adjust at the end of each month, decrease the prepaid insurance for what you did use, and put it into insurance expense to reflect that it was used during that month. So it's going to look very similar to what we did a moment ago with supplies. Let's imagine on January 1, Holden paid Farmers Insurance $1,200 for the whole year's office insurance. Well, we did not use the value, or we did not finish using the value on January 1, so we do not have an expense on January 1. On January 1, we have an asset. Debit the asset, and of course credit cash, but we're not examining cash, so just believe me, cash will be credit. Now the interesting part happens at the end of the month. What should the numbers be? Well, you know that this $1,200 is not accurate as of January 31. It was accurate back on January 1 before the insurance company protected and covered us during January. But on January 31, they are finished protecting us, they are finished covering us for January. So we have actually used $100 worth of insurance during the month. How do we record this in our records to reflect this? Well, insurance expense is debit for the amount that we actually used during January. And of course, we have to credit $100, the asset, to bring the value down to what it really is as of January 31. There are only 11 months left on the policy, so on January 31, the balance of this asset is $1,100. Now, of course, the $100 in insurance expense will go on January's income statement to show that during January we used $100 of insurance, and then of course that gets closed and becomes zero, so we can start measuring March's insurance expense fresh at the beginning of the next month. And of course the $1,100 goes as the balance on the balance sheet as of January 31 to show what we had in prepaid insurance going forward at the end of January. Chapter 13, Closing Entries and Partnership Distribution. We all know that every account in your chart of accounts has a debit side and a credit side. And depending on the type of account, sometimes the transactions are listed on the debit side for certain types of accounts and on the credit side for other types of accounts. The most important owner's equity account is the owner's capital. This is an account in your chart of accounts that reflects or shows the total money or value that the owner took from his or her personal funds or personal assets and put into the business. And of course, every chart of accounts should have a separate account for each separate asset, so you can account for how much value of that asset is in the business. In this example, let's imagine that the company has $10,000 in cash and the company has $20,000 worth of equipment. Well, if that's the case when the company starts, that means that the owner of the company has invested $30,000 worth of assets into the business, and the account that keeps track of how much the owner has invested in the business should say $30,000. Now, of course, the owner should also have a separate account called withdrawals. The reason for that account is to keep track of and take a total of all the money or all the assets that the owner took out of the business for personal, non-business use. For example, if the owner takes $2,000 of company cash out of the business for non-business use, that means that he or she would have to record that $2,000 in withdrawals, and the new amount of cash that the company has would be $8,000. The owner could also take home any other asset like equipment. For example, if the owner took home $5,000 worth of equipment, you would still have to record a withdrawal of asset from that owner of $5,000. That means the new value of equipment would go down to $15,000, and the new balance of the withdrawals account is $7,000. So as you can see, the owner invested $30,000 from his or her personal funds into the business, but withdrew $7,000 of cash and other assets from the business. And obviously you would have to net out these two accounts to know that the actual amount of owner's equity that the owner has in this company is $23,000. So then you might ask, how do you distribute the net income from the income and expenses accounts to the owner's equity accounts? Well, we will use the same two owner's equity accounts we used a minute ago, except now we're showing other accounts in the chart of accounts. Let's imagine at the end of the quarter or the end of the fiscal year, the service income is $20,000, and let's imagine in this example company there are only two expenses, $6,000 and $4,000 here. Now this example is showing you how to distribute the income when the company is a sole proprietorship. That means there's only one owner. In order to find out what the net income is, as well as distribute it or give to the owner or put into the owner's equity account the net income, we use a special account in the chart of accounts called income summary. This is a temporary account that begins with 0 and also ends with 0 when we're finished. We make a series of debits and credits in order to move the income to the income summary account and make all our income accounts 0. We also move all of our expenses to the income summary account and make the balance of all of our expenses 0. In the days before the computer, this would help make sure that the income and expenses do not accumulate into the next accounting period, and they begin with 0 at the beginning of this fiscal year or this accounting period. With the computer, it's not necessary to do it this way anymore, but at least we know in the income summary account that we can calculate the net income as $10,000. That's because we moved $20,000 to the credit side, and that was the income. We moved $10,000 worth of expenses to the debit side, and the net difference shows $10,000 more on the credit side than on the debit side. So we know the $10,000 is the net income. As I mentioned a moment ago, income summary also becomes zero. We take the ending balance of income summary and we bring it to the owner's capital account. This makes sure that the owner's capital reflects not only what they invested from their own personal pocket, but what they earned as their share of the net income. And of course, the last step in the closing process is to move the owner's withdrawals also to the owner's capital account. This way, withdrawals also starts with zero for the next accounting period, so you can clearly identify the withdrawals just for that time period. And when you find the end result of the owner's capital, we can see in this situation the owner is left with $23,000 of owner's equity, all of which will be in the owner's capital account when you finish doing the closing entries. If you need to know how to make debits and credits, you can watch the supplementary videos about journal entries included in this course. But the end result is that we now know the ending period capital for this fiscal year, which is also the amount of capital that will begin as the beginning balance in the next fiscal year. Now let's see what it's like to distribute the net income in a partnership. Here we have a situation where the company has two owners, Holden and Gary. And as you would imagine, each individual partner has to have their own capital account, which keeps track of the amount that they physically invested into the business, and each partner should have their own withdrawals account that keeps track of how much money or asset that particular partner took out of the business. So these numbers for Holden are left over from the previous example. Holden invested a total of $30,000 of cash or other assets from his personal funds, and he withdrew $7,000 from the business for non-business reasons. Whereas Holden's partner Gary only invested $20,000 from his personal funds, and he withdrew a total of $3,000 from the business so far this fiscal year. Now let's imagine in this example, Holden and Gary share the profits 60% Holden and 40% Gary. So, just like in our previous example, income summary is the account where all the income and expenses get close to, so we can determine the net income and distribute the net income to the partners. But in this example, we see that the net income is the same as the net income in the previous example, except 60% of it belongs to Holden and the other 40% of it belongs to Gary. That means that Holden will have an increase of $6,000 in his capital, and Gary will have an increase of $4,000 in his capital when we finally make income summary 0 to distribute the net income. Now, of course, both owners have to net out their own withdrawals into their own capital account. So the $7,000 of Holden's withdrawals gets close to Holden's capital, and the $3,000 of Gary's withdrawals gets close to Gary's capital, and Holden's capital, or total owner's equity at the end of this fiscal year, is $29,000 up here, and Gary's owner's equity at the end of this fiscal period is $21,000. Now we need to clarify something about our new friend, income summary. We all know income summary is where we move all of the accumulated income for the fiscal year and all of the accumulated expenses of the fiscal year. This way, the income and expense accounts don't accumulate into the next period, and we can isolate exactly how much income and expense came in and out during a particular time period. And the income summary will give us our net income, but you should know that income summary is a temporary account. the account that we actually use as a permanent account to show the difference between income and expense in a prior accounting period is called retained earnings. So retained earnings will still show the difference between income and expense, but only in a prior period. And that's how QuickBooks works. So, for example, if you look at reports dated in the current period, you will see the income and expense, and you will not see them in retained earnings. However, if you look at a report dated after the fiscal year end, you will not see any income or expense accounts listed. Instead, you will see the net amount as net income, or at least the accumulated net income, in the retained earnings account. For example, if Holden's fiscal year ends on June 30, any report dated before June 30 will show this: the income in the income accounts, the expense in the expense accounts, and nothing in retained earnings. However, any report dated after June 30 will show that you have zero income and expenses, and the net amount of net income has been moved to retained earnings. Now let's check how well we understand all of the end-of-month procedures by doing this hands-on end-of-month project. The end-of-month procedures that we just learned were adjusting entries after all the transactions have been recorded during the accounting cycle, and then after the adjusting entries, we learned how to make closing entries. And after the closing entries were mostly done, we then were able, as part of the closing entries, to distribute the partnership income. Now, you only saw a brief overview of these three steps in the end-of-the-month procedures. But let's see if you can figure out what to do and finish with the correct numbers in the project you're about to try. You see, the specific instructions start with asking you to download the Excel file that's in the Resource tab of this video, and everything you need is in the downloadable. You can easily access the files for all of these projects by clicking Show More, just like you did before to reveal the table of contents. But if you look all the way down at the very bottom of the description field, you will see that there are links to each of the project sheets for each of the projects. And if you just click on any one of the links to download them, all you have to do is click where the link is for this particular exercise, and you should be given an option to choose which folder to download the file to. So what are the specific instructions of this project? Well, first, use the end-of-the-month information that's given in the Excel file to make the adjustment in the T accounts that are given. Then, record the closing entries in the accounts. Make a post-closing trial balance when you're done, and then compare your results to mine. See if you finish with the same numbers by doing all the correct steps that we learned about in the end-of-the-month procedures. Now, what do I mean by using this file? Well, if you download the Excel file that says end-of-the-month project, you see that first you use the end-of-the-month information and make the adjustments in the T account. Now, you can see there are different tabs across the bottom. If I click here, I get a clear description of what the end-of-the-month procedures are. I should probably get rid of this so it fits in a little better here. So this is the information you need for the adjustments, and this is the information you need for the closing entries, and you can even pause the video here because there's not that much to remember, and then just go ahead and enter them. Now, you will enter them here. Oh, excuse me. This is the trial balance actually before you do the exercise. This is what all the beginning balance numbers are in the general ledger that you're given. So then you will read this information and record the appropriate debits and credits in this tab called the General Ledger. Now, it's zoomed out a bit, but if you zoom in, you can see that it's set up like the previous one, where all you have to do is enter a number and it will do the math for you, so you don't have to stress or do any work. So again, you can zoom in and out here from the bottom. If you click the bottom right, you can zoom in and zoom out. And I left the view zoomed out so you can better see the most of your accounts. But if you scroll down a bit by using the scroll bar here, you can see I've provided every account in the trial balance that I just showed you, every account including the income summary account that we learned about in a prior video. So you physically have everything you need to record all the debits and credits, and all of the beginning balances are already input from the trial balance that you're given to set up with. And when you finished, compare your trial balance to mine. And I gave you a special sheet for you to put in the results in your trial balance to tell me what you think the ending numbers are. Good luck and stay in touch.
Part 4. Have some appreciation for depreciation.
Chapter 15. What is depreciation? Now you may well ask, what is depreciation? Well, the word depreciation is a noun, and it means the amount of decrease in value of an asset that happens over time. The verb to depreciate is what we are doing when we record the decrease in value of an asset over time. You see, there's two kinds of depreciation. There's the type of depreciation that happens when an asset is no longer needed or desired, and that's not the type of depreciation that we account for when we keep books and records of a company. We are instead talking about the type of decrease in value that happens to the asset as you use it or use up the resource that the asset represents. You see, when an asset is no longer needed or desired, that condition is called obsolescence, or the asset has become obsolete. And that means that an asset is less desired and therefore less valuable. For example, you can buy a beautiful house worth a lot of money, and rest assured that if a week after you purchase the house they open up a nuclear power plant just 2 blocks down the road, you can be sure that the asset value will decrease. But that's not the type of decrease we're talking about. You can't control a nuclear power plant being built next to the house that you lived in for 20 years. You can't predict it regardless of how you actually use the house or the asset. And that's the reason why we do not use this thing called market value. You see, the market value of an asset is what people would be willing to pay for it at any given moment. And we know that it's volatile, so we do not use the market value of the asset when we record things in our accounting records. You see, the market value changes, but not related to the business operations. And if there's no relationship between using the asset and using up the value, then we really can't record the depreciation in our records, because then when we look at the resulting financial statements, it won't really be a reflection of how much of the asset we used. It'll only be a reflection of how much people are willing to pay. And that won't really help a person when judging how well a company is doing and utilizing their assets to run the company. And that's why that type of depreciation is not what we're talking about when we record depreciating assets. We instead use something called historical cost. Only record what you actually paid for the asset or to extend the life of the asset. That's what it means to record assets under historical cost. That does reflect a change in value as you use the asset. And it's the only legitimate way to compare financial statements between two different time periods. So let's explore using the idea of historical cost together. You see, when an asset value is being used up, you can picture the asset diminishing as you use it, and the amount of the asset you use over time becomes the expense. Just like we learned in the prior video. For example, supplies are an asset at the moment you buy them, because at the moment you buy them, you have something of value you can use into the future. Then as you use the supplies, the amount of supplies that gets used up becomes the amount of supplies expense that you record. Same thing with prepaid rent, like we learned in the prior video. When you first pay rent, you have something of value that you can use into the future. You have the right to use the space that you rented. But as time goes by, the amount of time that you rented for is being used up, and the amount that's used up becomes the rent expense that you report on your profit and loss. Now, of the three examples here, the clearest one is when supplies becomes supplies expense. You see, at the moment you purchase the office supplies like pens and paper clips and so on, you have them, you own them, they are assets at the moment you buy them because you can use them into the future. Then, as you use the supplies, the money you paid for the specific supplies that you use is the amount that becomes supplies expense on the next monthly profit and loss. You see, the remaining supplies still have value as of the balance sheet date. So whatever the money value is of what you paid for the supplies that you still have, should be the balance of the asset account supplies at the end of the month. And the amount that you report as supplies expense is the amount you actually used during the time period of the profit and loss or income statement, and it's the actual amount expended or used. And that makes for accurate financial statements that give a true picture of what's happening in the business and how well it runs. Now, this is the same idea for fixed assets. A fixed asset is an asset that you expect to have for more than 1 year. It can be things like a company car or a company truck, or it can be the office furniture that you buy and expect to use in the office for many years. It can even be a restaurant that owns a big freezer that they're going to use over many years to operate the restaurant. The idea is all the same. It's the idea of an asset being used up over time and becoming an expense. And the example asset, or should I say, the example fixed asset that we're going to use in this case is a car. You see, we know that a car only has a certain number of drivable miles that you can actually drive or use during the life of the car. And we all know that the more miles you drive in the car, the more you use up or depreciate the value, and the expense that represents a fixed asset decreasing over time is depreciation expense. So it's still the same idea of an asset losing value over time as you use it. And the important part that we learned in prior video chapters is that we record these in the T accounts in the chart of accounts. We know that the asset supplies represents the physical supplies that we still have on hand. And we know that as we use the supplies over time, Only the specific supplies that we use become the supplies expense, and the money amount of what we used gets recorded as a debit to the supplies expense and a credit to the asset supplies. You see, we have less of the asset supplies, and that's why we make a credit to decrease the value. And therefore, the value is lower on the next balance sheet and only reflects what we paid for the remaining supplies. We then, of course, debit the supplies expense account only for the amount that was actually used or used up during the time period that the income statement or profit and loss is reporting on. And that's the amount that will show on the income statement or profit and loss. And since the idea is the same, we can make T accounts that represent the car and depreciation expense, except in this case, what's being used over time is the drivable miles of the car at the moment that you buy the car. You see, a car only comes with a certain number of drivable miles that you can physically drive as you use the car in the future to run the business. And as you drive the miles over time, whatever miles you drive, or let's say the cost associated with whatever miles you drive, will decrease the value of the car in your books and records, and those miles or the cost associated with those miles will become the depreciation expense that you report on your profit and loss during the time period that you actually drove those miles using the car. And of course, as you drive the car over time, there are fewer miles available in the future to drive the car, and that's why you would credit the asset to lower the value exactly the way that we learned in the prior example and the prior video. That makes a lower balance on the balance sheet to represent what the car is worth when someone looks at the value of the car on the balance sheet. And of course, the actual miles expended or used up, or let's say the cost associated with the miles that were expended or used up, go as a debit to the depreciation expense account to show the amount that you will put on the profit and loss as the amount of expense associated with lowering the value of the car. But then the question is, how do you record it in your books and records at the end of each period? Well, the idea is exactly the same as what it was when we used supplies in our previous example. We would make a normal monthly adjustment to adjust for the decrease in value of the asset and to acknowledge the amount that was expended during this period. We would have to make a credit to the asset account to lower the value, and we would make a debit to the depreciation expense to show how much was used or the cost associated with whatever was used up during that accounting period. Chapter 16. How much to depreciate? If you want to know how much depreciation to record, you first ask yourself, how much of the car did you use? And when we ask that question, we're talking about the money value of the amount of car you used regarding the miles that you're able to drive. So how do you calculate an credit adjustment for depreciation? Well, the first important new phrase that we will learn regarding finding out how much to debit and credit for the depreciation adjustment is the phrase useful life. You see, useful life means how many years will the asset give service and produce value that we can use in our business. And in the case of the car, it means how many miles will the car be drivable and produce valuable services that the business can use. Now, how do you calculate and find useful life? Well, first you have to figure out how much of the car did you use. Now, what does that mean? Well, you have to use a logical comparison to determine during any period of time how much of the car you actually used. And logically, the way we do this is we compare how many miles you actually drove this particular accounting period, whether it's a month, a fiscal quarter, or a year, and we compare that many miles that we actually used to how many miles you could have driven if you completely used up all of the useful miles in the car. By logically comparing this, you can figure out how much of the car you used, and then mathematically, what's the money amount of the car that you used during the period. That's your depreciation adjustment. So, useful life, you should know, is always an estimate based on past data and past statistics. If you buy a car, it's not going to be exactly the numbers in miles they predict, but based on past services and past information about that car, you should be able to estimate the useful life in miles pretty accurately. For example, let's imagine on January 1 of 2025, we purchased a car for $10,000. And let's imagine that the estimated useful life on this car is 10,000 drivable miles in its lifetime. Well, how would we record the purchase? We already learned how to do that in prior videos with simple debits and credits. If we paid cash, then we would credit cash 10,000 because the asset cash decreases, and we would debit the car 10,000 for the amount that we paid for the car, and that would reflect the value of the car in our books. Now, continuing in the same example, let's discuss the difference between how much we could drive and how much we did drive. How do we find that out? Well, we know we paid $10,000 for the car. And we know that there's 10,000 drivable miles that we can drive during the life of this car before we have to scrap it. Therefore, we could consider the money value of every mile driven to be $1 per mile. That means that the value of the car, from the point of view of someone who's using the car, not planning on selling it, the value of the car decreases $1 every time a mile is driven. That's in theory. That's the idea of depreciation based on usage. So, in theory, each mile you drive, you use or expend $1 of the value from the original purchase. That means that we have to then use that $1 per mile to figure out the monthly adjustment amount. And if we know that we lose $1 in value every time a mile is driven, then what we need to do is look on the odometer and see how many miles have been driven since the last accounting period. So let's imagine on January 31, the odometer on the car shows 500 miles have been driven during the first month of using the car. And if it's $1 per mile that we figured out a moment ago, that means in theory you expended or used up $500 worth of car, or let's say accumulated $500 worth of depreciation on the car for driving it 500 miles. So then what would we do? We would have to debit depreciation expense car for the monthly adjustment amount, and that's the expense that would show up on the profit and loss to show how much of the car's value was used during that period. And of course, the balancing credit would go towards the asset, so that the net amount would show up on the balance sheet as the actual value of the car reflected in drivable miles. In other words, there would be 9,500 remaining drivable miles in money value as of the date of the balance sheet. And of course, $500 of depreciation expense is the money value of the actual driven miles, and that would show on that particular period's, in this case January's, profit and loss as depreciation expense. Now let's do a different example so the numbers are not as round. For example, let's imagine instead on January 1 we purchased a car for $15,000, and in this case the estimated useful life is 30,000 drivable miles in its lifetime. So therefore, the first thing we need to do is calculate the cost per mile in theory regarding the purchase cost and how many miles we can use. So if we paid $15,000 to be able to drive 30,000 miles, that means in theory, each time we drive a mile, we are using up 50 cents out of the $15,000 that we paid for the car, because the reason that we paid $15,000 is to be able to drive 30,000 miles to use the car for our business. But what would be the monthly adjustment amount in this case? We know the car in this example would start off with a $30,000 debit balance. But in order to know the monthly adjustment amount, we would have to again look on the odometer and see how many miles were driven during the specific month that we are preparing our financial statements for. And we see in this example that we drove the car 1,450 miles during January. And if it costs us 50 cents in value every time we drive the car, it means we have expended or used up $725 of what we paid for the car during January. So that's the amount of depreciation expense that we would record. And again, we always debit depreciation expense for the value that was expended or used up, and we always, in theory, credit the asset so that when we get the net value of the asset, we can see that the remaining drivable miles in money value as of the balance sheet date shows up as the balance of the car. And of course, only the money value of the miles that were driven or expended and used during the period will show up as depreciation expense for that particular month's profit and loss. Chapter 17, Depreciation Methods. You see, we actually learned one way already. Our first example with the car is the example of the unit of production method. You see, this method is depreciation based on usage. You would first divide the total purchase cost of the asset by how many units in the useful life. This will give you the depreciation amount per unit. Like we did with the car when we divided the total purchase cost of the car by the estimated number of miles that the car could be driven in its useful life. That gave us the cost per mile. But if it's another asset, it's cost per unit. You then multiply the unit amount by how many units were used, or in the case of the car, driven, during this specific accounting period, and that would give you the money amount of the adjustment to debit the depreciation expense and lower the value of the asset. That's the one that we already did, and you can go back and look at that and apply that to any kind of asset, whether it's a car or a piece of manufacturing equipment or anything you needed. The second common method of calculating the amount of depreciation expense is called the straight line method. And it's called the straight line method because every year has the same amount of depreciation for the asset. This method is based on the time that you spent using the asset. You divide the purchase cost of what you paid by the total number of years in its useful life. That's the amount of depreciation each year if you make an annual depreciation adjustment. And if you report monthly, then you divide the annual amount you found by 12. And the third method of calculating depreciation is called accelerated depreciation. It's when you record more depreciation expense in the early years of the asset and less in the later years. In Accounting 101, we learned some number trick patterns that we use to calculate more depreciation in the early years of the asset's useful life and less depreciation expense in the later years of the asset's useful life. And for taxes, it helps us deduct more depreciation expense in the early years if we choose to. And then this will help the business save on taxes until it can grow and get strong. Now let's do an example of straight line depreciation. Let's imagine on January 1, we purchased a $50,000 truck with the estimated useful life of 10 years. Of course, the truck will have a $50,000 debit balance in the asset account after you purchased it. But what's the annual adjustment amount that you have to record? Well, if you paid $50,000 for a truck that you're able to use for 10 years, then in theory, you're using up $5,000 of the $50,000 that you paid every year that you continue to drive the truck. So then how do you record the annual adjustment? Well, of course, it would be debit depreciation expense $5,000 and credit the truck $5,000, just like we learned in the prior example. However, that's not the proper way to record and display the depreciation adjustment or the depreciation against the truck. You see, of course we have to debit the depreciation expense account $5,000 because this shows the value that was used during the period, and that expense will go with the rest of the expenses on the profit and loss. But the balancing credit does not go directly to the asset account. Instead, the balancing $5,000 credit goes to another account that's connected to the truck account, and instead of putting the credit directly to the truck, we put a credit to this account here, and it's called accumulated depreciation. And accumulated depreciation is a T account in the chart of accounts that only exists to be able to hold the amount of depreciation that has accumulated on any asset so you can compare it to the actual asset cost. Now, this is your first introduction to the idea of something called a contra account. You see, a contra account is an account that exists only to decrease another existing account. So, these two accounts go together. They must be shown together on the financial statements or they mean nothing. You can think of them like conjoined accounts, where you can't have one without the other, and you must present both of them together so someone looking at the financial statements can see how much you paid compared to the theoretical value of the amount that was used. So if you look at the fixed assets section of a balance sheet, you will see three numbers for every asset that you have to depreciate, because looking at only one number is not really enough information for people looking at your financial position to really understand the value of the truck as it relates to how the company uses the truck for business. But if you display all three numbers together, That will give the reader of the financial statements a whole picture of the value of the truck as an asset in the company. And you may well ask, what happens the second year that you depreciate? Well, we know that each year's depreciation amount is $5,000. So no matter what, at the end of each year, even the second year, we have to make a debit to depreciation expense to show the value of the truck that was used up during only the second year. But after you make the debit to depreciation expense, again, the balancing credit goes to the conjoined account, accumulated depreciation on the truck. And that's why they call it accumulated depreciation, because now a second year's depreciation has accumulated, and that means the total decrease in value since we purchased the truck was $10,000 against the $50,000 that we purchased. And at the end of the second year, the amount of accumulated depreciation in the account would show up in the fixed assets section as $10,000, and therefore, if the depreciation was $5,000 more, that means the second year the book value would be $5,000 less. So this shows the reader we purchased the truck at $50,000, but $10,000 out of the $50,000 has been used as we use the truck in business, and therefore the real value of the truck is $40,000. So simply put, more accumulated depreciation means a lower book value for the truck shown on the next period's balance sheet. And this was a pretty simple example because each year's depreciation was the same amount. But what about accelerated depreciation? How would you handle it in that case? Well, accelerated depreciation means that you record more depreciation in early years and less depreciation in later years. You notice the overall amount of depreciation is the same, but you get to deduct more expense in earlier years when your business might need the deduction more. So there are two common methods of accelerated depreciation. One is called sum of the year's digits, and the other one is called double declining balance. And they're both under generally accepted accounting principles when you report your financial statements. They're both very simply number patterns that give us a depreciation table that tells us how much depreciation to deduct each year, where the numbers at the beginning of the table for the earlier years are higher and the numbers at the end of the table for the later years are lower. And this makes the more depreciation expense in the earlier years and less in the later years. There's no point in getting into them now. They're simply elementary school number tricks that you can find from your textbook. Chapter 18, Depreciation for Taxes. The IRS explains everything. The Internal Revenue Service makes available publication number 946, which explains everything about how to depreciate property. And in this publication, they give charts and tables that break down different type of fixed assets into categories. And these categories are called class life. And if you can look up the type of asset you have and find what class life the asset belongs to, then you can use these columns and rows to make a separate depreciation schedule for each asset. You see, the way it works is that some property falls under 3-year property in that category, things like some cars. But then there's other property that's considered 5-year property, like farm equipment and so on. So you would first look up in the tables which category or how many years it would take to depreciate that specific asset. Then once you do that, you would then make a separate depreciation schedule based on the category of that asset. For example, if the company car was 3-year property, then you would use the 3-year column numbers to make the full schedule. And the only reason for the full schedule is to be able to see how much depreciation you will deduct for that specific asset for each of the years of the asset's life. So the numbers for each individual tax schedule for each asset come from the tables in the publication from the IRS. This is an example of 3-year property, and this is what this schedule would look like. If it were 5-year property, like some farm equipment, then again, the schedule for that piece of equipment would come from the column of 5-year property. And that's what that would look like if it cost $10,000 to purchase. And here are 2 separate depreciation schedules for 2 separate example fixed assets. And the way to find total depreciation expense for the year would be to use the amount of depreciation for the specific year for each asset. For example, let's imagine that this is the 2nd year of using the equipment. So we would look on the 2nd row and deduct the amount that the schedule indicates as the depreciation expense for the 2nd year for this specific fixed asset. But let us also imagine in this same year that it's actually the 3rd year using the company car. So we would look in the row of the 3rd year of depreciation to determine how much depreciation expense we should have for the car. And if these were the only 2 fixed assets in this example company, that means you would add them together, and total depreciation expense in this example would be $7,242. Many companies only have one fixed asset account for all their assets and for all their depreciation. And if that were the case, then the $7,242 would go as a debit to one specific account, depreciation expense, and the balancing credit would go to one specific account, accumulated depreciation on all fixed assets. You could have a separate set of T accounts for each individual fixed asset, but many companies lump them together and use the separate depreciation schedules to keep track of them separately from year to year.
Part 5. All about merchandise inventory.
Chapter 20. The Perpetual Inventory System. We have already learned how to record an income from a service. It's just one T account that represents the total money that came in from what we earned. In previous cases, it was just one number, the service fee, and it represented the price of the service. So you previously made a credit to this income account for exactly what the customer gave you. However, when we have merchandise that we're selling, we still have an income account that represents the total money that came in from the customer for merchandise sales. But in a case of a merchandise company, we're not dealing with one number in the income section, we're really dealing with 3 numbers. The sales price of the merchandise, which will get recorded as a credit to this income account, the same way the income from a service got recorded to the service income account. But with merchandise, we also have to consider how much did the merchandise cost you when you bought it. Because the difference between the price that you record as income and the cost that you pay for the merchandise will be your profit. Now, the most important words in this video are the words cost and the words price. And you have to make sure you know the difference between the word cost and the word price. Cost means the amount that we paid to purchase the merchandise from the vendor. But for that very same merchandise, the word price means the amount we received from the customer when selling the merchandise. And of course, the difference is your profit. Price minus cost equals profit, and we all know that, but only if the goods are sold. So we therefore have to clarify our definition. We should really say the price of the goods that were sold minus the purchase cost of the goods that were sold is what really equals our profit. The price of the goods that are sold is the value that the customer gives us. The cost of the goods that are sold is the value of what we gave to the customer. It's what we paid for the goods that went out. The word perpetual means continuously changing. That means if we're using the perpetual inventory method to record the sale, the account inventory asset changes after each transaction. That means it changes after we buy the merchandise, and it also changes after we sell the merchandise. Now, of course, in the top right here, we have our sales income account. This is very similar to the service income account that we were using in previous videos. You record a credit for what the customer gives you, because that's the income that you earned. So previously we made a credit for the price of the service when the customer paid us, or when we earned the service income. So now when we deliver the goods, we make a credit to sales income for the price of the goods that are sold, because that's the income that we earned, and that's a T account just like service income. However, the interesting stuff happens down here in the cost of goods sold account. This is not technically an expense, even though it behaves like an expense, and even though it has the same effect on income. It would go in the income section as a contra income account, not an expense account, because it's part of the income cycle. You have to buy, then sell. Then you can subtract your expenses to find your net income. So that explains a little bit about this new account in the bottom right, cost of goods sold. And now let's see how to use these accounts when we purchase and sell merchandise. First, let's give cash a beginning balance. That's not a transaction. We're just pretending that we're starting off with $10,000 cash. Now here's our first transaction. Paid $300 to purchase merchandise. Well, we know if we pay, cash is minus, cash is credit. And just like purchasing any other asset, exactly what we paid for the asset becomes a debit to that asset for that date. So this purchase transaction is no different than the ones we've learned before when we purchased other assets. But the interesting part comes here. When we sell with Perpetual, we record it twice, once for the cost and once for the price. Now that's a lovely little rhyme, so let's say it again. When we sell with Perpetual, we record it twice, once for the cost and once for the price. Let's take a look at an example. Let's imagine on January 8, we sold the specific merchandise that we purchased on January 1, but we sold them for $1,200. So you can see this is the merchandise that we purchased back on January 1. This is the merchandise sitting here waiting to be sold. Now, if we sold it for $1,200, it means that the customer gave us $1,200, and it also means we've earned $1,200 worth of income for selling the merchandise. So what would be the debits and the credits? Well, if we've earned $1,200 worth of income for sales, and we know that income is credit, on January 8th, we would have to credit the sales income account for the $1,200 that we earned. On the other hand, the customer gave us $1,200, so we have no choice but to debit cash on January 8th for the $1,200. So this first debit and credit looks just like it looked when we sold a service. Credit the income and debit the cash. However, there is now an extra step for this same January 8th sale. For this January 8th sale, we also have to credit inventory because this $300 of inventory is no longer here. It went out. So we have to remove it from inventory by making a credit of $300. So then what would we debit $300? And obviously the answer is cost of goods sold. Credit inventory for the merchandise that went out and debit cost of goods sold for the purchase cost of the specific merchandise that we gave to the customer. Can you guess the profit from this particular sale? Of course, the profit is $900. Anybody could figure that out because it was only one sale. Watch another one. Let's imagine on January 20, we purchased $500 more of inventory. Again, that's the easy one. We have $500 more of this asset, and on the other hand, we have $500 less of cash. So we know purchasing under the perpetual system is very easy. Debit the inventory that you got and credit the cash. Now, again, the interesting part is when you actually sell. Let's imagine on January 31, we sold the specific merchandise that we previously purchased on January 20, and we sold it for $3,300. Well, here's the merchandise that we purchased back on January 20, so we know that has to come out of inventory. But what should we do first? Well, we've actually earned $3,300 by receiving that from the customer for giving them the merchandise. So always income is credit for what we earned. And if the customer gave us $3,300 in cash, we have to debit cash. So the debit and the credit for the price of the January 31 sale is credit sales income and debit cash. But we're not finished. This specific $500 of inventory went out on January 31. So we credit inventory $500. Then what do we debit $500? Well, $500 was the purchase cost of the goods that we gave the customer on January 31, the specific goods. So here we have the debit and the credit for the cost. So we have four accounts changing when we make a sale. Credit sales income and debit cash for the price and the income we earned. Credit inventory for the cost of the goods that are sold, and debit cost of goods sold. Now, obviously, at the end of the month or the end of the period, we would get the total of the sales income and the total of the cost of goods sold, and we would eventually put them together to find the profit from our merchandise operation. In this case, the profit is $3,700. But when you're an accountant, you're not finished when you calculate the profit. The profit is the result of the income section of our operation. We then have to subtract out all the other expenses that we learned about in previous videos to get the final number, the net income. In fact, sales income and cost of goods sold are together in the income section of the income statement, and the expenses are at the bottom. They're both in the income section because both buying and selling are part of the revenue cycle. And if you have a merchandise business, the gross profit is the result of the income section. You then simply record all your other expenses and subtract them the way you did when you had a service business to find your final net income. Chapter 21, the Perpetual Inventory System Project. Let's check your knowledge and skill regarding merchandise transactions. And we'll also check your knowledge and skill regarding the income statement of a merchandise business. So, the specific instructions in this project are to download the Excel files in the Resource tab of this video. Everything you need is in the downloadable Excel. You can easily access the files for all of these projects by clicking Show More, just like you did before to reveal the table of contents. But if you look all the way down at the very bottom of the description field, you will see that there are links to each of the project sheets for each of the projects. And if you just click on any one of the links to download them, all you have to do is click where the link is for this particular exercise, and you should be given an option to choose which folder to download the file to. You see, the specific instructions are: record all transactions into the general ledger provided, find the results of each account, and make a trial balance with the ending numbers of the general ledger, and then from those numbers make an income statement of a merchandise company from the resulting numbers in the trial balance. When you click to open the file, this is what the file will look like. It'll say the name of it up here, and you'll have the general instructions in the first tab. The second tab gives you the starting trial balance. The third tab gives you the list of transactions that you need to read and reminds you that what the purchase cost and the sales price of each item is. Now, here's the blank general ledger for you to physically put the debits and credits. You can zoom in or zoom out if you want to see more of them at once. And if you click and put in a number like a debit or a credit, you will see it automatically adds it for you, so that will save you time rather than using a pencil and piece of paper. When you finish, make your own numbers in the final trial balance, and then from those numbers, here we have a blank sheet for you to make your profit and loss. Don't peek at the general ledger results or the final trial balance or profit and loss unless you've really exhausted every ounce of energy that you have trying to get the final numbers correct. I wish you good luck, and I'm here if you have any questions. Chapter 22, the Periodic Inventory System. The periodic inventory method is appropriate if you cannot keep records of specific quantities on hand after each transaction. If that's the case, then you must use the periodic inventory method of recording your transactions. You see, with this method, you can only calculate cost of goods sold when you are ready to report your profit and loss and the rest of your financial statements. You don't calculate it in the accounts like we learned with the Perpetual method. You instead calculate the cost of goods sold right on the income statement. Now, what am I talking about? Well, the profit and loss of a merchandise company has sections and subsections. The numbers are in a relationship to each other, and cost of goods sold still means the same thing, but you can only find it at the end of the month or the end of the accounting cycle when you're ready to report your numbers. So, what did we already learn about the profit and loss of a merchandise company? Well, we know that we first calculate how much money came in from the customers for the merchandise we gave them. And common sense says we then subtract what we paid for the merchandise that we gave the customer. And the amount that we paid for the merchandise we gave the customer is the cost of the goods that were sold. And if we subtract them out, then we get our real profit from buying and selling the merchandise. Now, most of you remember this from your elementary school days. But when you find your gross profit from the merchandise, you're not really finished. You still have to subtract out operating expenses and any other service you needed to pay for in order to be able to buy and sell to get your real final result, which is the net income. And hopefully you've seen this before in your accounting class or in your travels, and hopefully this structure makes sense to you and should be very simple. However, you should know that when you use the periodic method of inventory, cost of goods sold is comprised of 4 separate elements. You see, you can't have a T account for the cost of goods sold if you have too many products to keep track of. So you do a series of logical steps to find and calculate the cost of goods sold. First, you start with beginning inventory, which is a T account in the general ledger that doesn't change as you purchase merchandise if you are using the periodic method. Instead, when you purchase merchandise, all of your purchases gets recorded in a T account called purchases. And then, of course, logic suggests if you add what you had in the beginning inventory plus your purchases, you would then get a number that represents the goods that were available for sale. And the last logical step to back into finding what the cost of goods sold is to subtract out your ending inventory, and then once you get that result, then you have the cost of goods sold to put into your income statement, subtract from your sales income to find your gross profit. And these are the 4 elements and the logical steps that you would do at the end of the month and show on the income statement in order to show that you have an accurate cost of goods sold and therefore an accurate gross profit and so on. But why is it that the cost of goods sold steps seem a little challenging? It's only because you're using the words in accounting instead of using common sense words. Think about what cost of goods sold is. It's what we paid for what went out. It's what we paid for what we gave the customer. So all we have to do is use different words and it will be clear and common sense exactly what cost of goods sold is. Instead of using the words beginning inventory, let's just say we had some. Because whatever your beginning balance of inventory is, represents what you had at the beginning. You had some. But then during the month when you record your purchases, you bought more. So instead of calling it purchases, call it how much more you bought. And logic dictates if you add what you had at the beginning plus what you bought, then you get a number that represents what you could have sold. So goods available for sale is the total that you had the ability to sell. We then subtract what we did not sell. And logic dictates if you subtract from what you could have sold the amount you did not sell, then the number that remains is what you did sell. So logically speaking, goods available for sale, which is what you could have sold, minus ending inventory, which is what you did not sell, equals what you did sell. And what you paid for what you sold is the cost of goods sold. So here's a practical example from an Amazon online store, keeping in mind that any company with too many different types of products and large volumes cannot keep track of the cost of goods sold for each sale, And just like a supermarket, they must count the inventory after each period that they want to report their numbers and use the periodic system. So here's the practical example. You cannot know your profit unless you know how many items were sold during the month and how much money of item costs were sold during the month. In other words, how much you paid specifically for the products that you gave the customers. Most Amazon sellers do not keep count of the quantity of items after each sale or after each purchase. So how do you know how many items and how much money of inventory was sold during the month? The solution is to use old school elementary steps to basically back into the amount of cost of goods sold during the month. So what does that mean? Well, let's think of it from an elementary school's point of view. Let's imagine at the beginning of the month you had some inventory. For example, you had 10 items. Then let's imagine during the month you bought more, and you kept track of how many you bought during the month, and that was 20 items. Now you don't know exactly how many you sold because you did not keep quantities of that which were sold, but what you can do is physically count the ones that remain and are with you at the end of the month. And if you count the amount at the end of the month in this example, and you have 5 items left over, how would you find out how many actually were sold and went out? Well, in order to know that, you would have to be able to add the first 2 numbers together. In other words, you would have to find out how many you were able to sell, and then of course you would subtract out the amount that you did not sell, which is the amount left over. So if we were able to sell 30 and we did not sell 5, then how many did we actually sell? And of course, the answer is 25. Logically, if we had some, for example, in this example, we had 15 at the beginning of the month. Then during the month, we bought 45 more. Well, we don't know how many were sold, but we know we can physically count the ones that are left over at the end of the month. And in this example, there were 25 left over. So remember, in order to find out how many you did sell, the first step is finding out how many you were able to sell. And in this example, you were able to sell 60 and had 25 left over. So in this example, how many did you sell? Well, you sold 35 because 60 that you were able to sell minus 25 that you did not sell because 25 was left over logically equals the 35 that you did sell. And now we will do the same thing we just did, but we will do it with money amounts instead of counted quantities. For example, let's imagine at the beginning of the month we knew we had $250 worth of merchandise inventory. That means we paid $250 for the items that were sitting here at the beginning of the month. Then during the month we kept track of how much we paid to buy more inventory. And therefore we know the money amount that we were able to sell. We could also check the amount left over in ending inventory and figure out what we paid for that, so we know the money amount of what remains. And logically, we could figure out the money amount of the goods that were sold. And we know in this example it was $300 because $800 worth of inventory that we were able to sell minus $500 worth of inventory that we did not sell equals $300 worth of inventory that we did sell. And since we paid the cost for that $300 that we did sell, the $300 in this example is the cost of goods sold. And now we will do the same thing we've been doing, but using the proper accounting words. For example, instead of saying we had some, we're going to say beginning inventory was $250 worth of merchandise. And instead of saying we bought more, we'll call the amount that we bought more the very important word purchases. So these are the words that we would use when doing accounting and calculating our cost of goods sold. Now, the word able is in the phrase able to sell. So instead of saying the amount we were able to sell, the official word for this number is goods available for sale. And of course, instead of saying the amount left over, we call the amount left over ending inventory. So what's the proper word for the result? Well, the result is what you paid for the goods that you sold and went out. So if in this example $300 worth of merchandise went out, then that's what we call the cost of goods sold. Because $300 is what we paid for what went out, because in this example $800 worth of merchandise is what we were able to sell. That was the goods available for sale. $500 is what we did not sell. That was the ending inventory. So logically, we sold $300 worth of merchandise, and $300 is the cost of goods sold. Now let's do another example with the proper words. Beginning inventory was $400. Then during the month we purchased $350 more worth of inventory. And when we physically count the inventory at the end, we know we have $150 worth of inventory still sitting here. So of course the next step is to find out how much money worth of inventory we were able to sell, and that's the goods available for sale. So beginning inventory plus purchases equals goods available for sale, and goods available for sale minus ending inventory equals the cost of goods sold. And in this example, it is $600 because $750 were the goods available for sale, $150 was the ending inventory, therefore the cost of goods sold in this example was $600. Now, we need to know the cost of goods sold so that we can subtract it from the money that came in sales income to calculate the gross profit. Because common sense dictates the money that came in from sales minus the cost of goods sold, which is what we paid, equals the profit on the sales of the merchandise. So how was this done in the old days in the chart of accounts? Well, the sales were recorded this way. We had a separate account in the chart of accounts just to record all the money that came in from sales. And only the money amounts that the customers paid us got recorded in the sales income account, because that was recorded at the same time in the cash in bank account that we used in our general ledger to keep track of how much money we had in the bank. So we knew if it came in and it was a plus to the bank account, that it was also sales income. And each individual sale was recorded on the credit side of the sales account to keep track of the income, and the debit side of the cash and bank account to keep track of how much money was in the bank or came into the bank account. Then, of course, at the end of the month, we would total the money that came in from the sale, and that amount would be the sales income that we would subtract out the cost of goods sold to find the profit. So then you may ask, how were purchases recorded? Well, we had a separate account to record the money amount each time we purchased inventory, and of course, that was matched to the deduction of the bank account every time we paid for the purchase. And in the purchases account, we only put the purchase cost. We only put what we paid for the merchandise that we purchased. And every time we did that, we put the money amount on the debit side of purchases to keep track of everything we paid, and the credit side of the cash in bank to keep track of each reduction to the bank account. And after each purchase was recorded in the purchases account during the month, at the end of the month we would get the total purchases, and the total purchases would help us find the cost of goods sold to be able to subtract from the sales income to be able to determine our profit. But we know that what we paid for the purchases is not exactly equal to what we pay to what the cost of goods sold is. So how did we actually find the cost of goods sold? Well, we had our purchases account, and we had another account to keep track of the inventory, which is an asset, and that account kept track of what's physically here at the end of one month and the beginning of another. And then, of course, we had a separate T account just to show us the amount of cost of goods sold. And what would we do? Well, we would start with the beginning inventory. That means that if we looked at the inventory asset account in our chart of accounts, at any given moment, it would only show the amount of inventory we had at the beginning of the month. Now let's just remind ourselves what the calculation was. Beginning inventory plus purchases equals goods available for sale. Goods available for sale minus ending inventory equals cost of goods sold. So, the first thing we would do is remove the beginning balance from inventory asset and move it to cost of goods sold. We would do that by making a credit to the inventory asset to wipe it out, because that's no longer the inventory amount. That was the amount at the beginning. So since the number at the end of the month is not the same, we make a credit to wipe it out, and the balancing debit goes into the account cost of goods sold. Now the inventory asset is 0 after step 1. Now what would be step 2? Move the purchases to cost of goods sold. Purchases normally had a debit balance, so we made a credit to wipe it out and make purchases 0 so that we could account for only the purchases in each individual month, and purchases will become 0 as a fresh balance to record the purchases in the next month. And the balancing debit, of course, goes to cost of goods sold. Now, cost of goods sold now has this final third step. The ending inventory will go as a decrease to cost of goods sold. And we know the amount that we physically count at the end, which is the amount left over, gets subtracted in our little calculation. So that's why it goes on the credit side of cost of goods sold, because it gets subtracted. And of course the balancing debit goes into the asset account inventory, so that now is the ending inventory of this month, and now going into the next month, the inventory account reflects what's the beginning inventory in the new month. And now our cost of goods sold account in the chart of accounts has every part of the calculation. On the left, it has the beginning inventory and the purchases. So the total on the left is the goods available for sale. And we know that on the right side, it has what's left over that we subtract out as the ending inventory. So when we take the total debit side of cost of goods sold minus the total credit side of cost of goods sold, we get the actual balance of cost of goods sold, and in this example, that's $8,000. And that's how we found out the cost of goods sold, by managing the chart of accounts in the days before the computer. And that cost of goods sold is what we would subtract from the sales income to get the gross profit from buying and selling merchandise. After that, we would subtract our general administrative expenses to get the net taxable. Chapter 23. The Periodic Inventory System Project. The profit and loss of a merchandise company has sections and subsections. The numbers on the profit and loss are all in a relationship to each other. And it's remembering and understanding this relationship that will help you learn and remember the merchandise accounting that you studied in this course. You see, the specific instructions to this puzzle are as follows. Download the 2 Excel files in the Resource tab of this video. Then use the Excel file to fill in the missing numbers by using your knowledge of the different parts of an income statement of a merchandise business. And everything you need is in the downloadable. You can easily access the files for all of these projects by clicking Show More, just like you did before to reveal the table of contents. But if you look all the way down at the very bottom of the description field, you will see that there are links to each of the project sheets for each of the projects. And if you just click on any one of the links to download them, all you have to do is click where the link is for this particular exercise, and you should be given an option to choose which folder to download the file to. We know that sales income is the money the customers give you for the merchandise that you give them. And we subtract from that the cost of goods sold. And we know that the cost of goods sold is what we paid for the merchandise that we just gave the customer. So logically, if you subtract the money the customer gave us in sales minus what we paid for the cost of goods sold for the merchandise that we gave the customer, that difference, we all know, is your gross profit. And we all know what profit from a sale means. But of course, we're not finished with the income statement once you get the gross profit, because that only accounts for buying and selling the merchandise. We know very well that if you buy and sell merchandise, there are additional expenses that you have to subtract from the profit of the sale of the merchandise to finally arrive at the true amount of money that you actually made, called the net income. And most of you remembered this from your elementary school days when you did practical, simple projects. However, what you learned in Accounting 101 is that cost of goods sold actually is comprised of 4 elements. To get the cost of goods sold, you need to have your beginning inventory counted last month. You have to add the amount that you paid for all the merchandise that you purchased during the month or the period, and that would give you a number called goods available for sale. And what you were able to sell minus what you did not sell, because it remains an ending inventory, then you will know your cost of goods sold. Then you will know the amount that you paid specifically for only the items that went out to the customer. So, since these are the elements, and this is the math relationship, you should be able to do this exercise. So let's take a look at what the sheet looks like. You'll notice there are 1, 2, 3, 4, 5, 6, 7 little puzzles across 7 little sheets in this Excel exercise. And all you have to do is find the missing numbers by using the math relationship you learned about a moment ago. Okay? Now, most of them should seem easy, but if purchases is the number that's missing, how do you figure that out? How do you figure out what purchases is when you're usually given beginning inventory and purchases and you have to find the goods available for sale? But in this case, you're given the goods available for sale and beginning inventory, and you have to find the purchases. So how do you do that? Well, we know that beginning inventory plus purchases is equal to goods available for sale. And if you think about that for just a couple of minutes, you'll remember from elementary school that it follows, therefore, that goods available for sale minus beginning inventory equals the purchases. Just think about the math relationship and some of the puzzles you did in elementary school, and you will understand why this is true. So, if we know beginning inventory and goods available, we can find purchases. Purchases is equal to the goods available minus the beginning inventory. Now again, you don't have to use Excel and you don't have to use math formulas. If you don't know Excel, just use a calculator and type in the number in the empty space. So we used this logic going backwards in order to find out the missing number. Now, to find the remaining 3 missing numbers, that's easy. We just go back to the math relationship that we learned about a moment ago, and we can finish putting in the rest of the numbers. For example, what's the cost of goods sold? Well, we know that it says here, goods available for sale minus ending inventory equals cost of goods sold. No problem. Goods equal to goods available for sale minus the ending inventory equals cost of goods sold, just like it says in the layout of the diagram of the income statement of the merchandise business. Now, how to find gross profit? Well, it says it right here. Income minus cost of goods sold is equal to gross profit. So that's what we put. We put equal sales minus the cost of goods sold, which is in B8. And now that's your gross profit. And then, of course, we look one last time. Gross profit minus total expenses equals the net income. So gross profit, this one, minus total expenses, which is in B10, equals the net income. So that's how you do it. You don't need to use Excel. Just click in the field and type in the number and hit enter. And just by doing these little puzzles, you will be an expert by the time you finish. Try the rest of the sheets yourself. I know you'll be an expert if you give yourself time to finish each sheet. Stay in touch, good luck, and if you have any questions, please reach out to me immediately.
Chapter 24, The Weighted Average Inventory System.
Changing purchase costs can be a challenge when you're trying to track your cost of goods sold to subtract it from your sales income to determine your profit. Purchase cost of items sold, as you know, get recorded in the cost of goods sold account. QuickBooks needs to know the purchase cost of the items that were sold in order to be able to calculate the amount of cost of goods sold for that particular sale. If all purchase costs always stay the same, then QuickBooks will always know how much to put into the cost of goods sold account when you sell your merchandise. Unfortunately, if purchase costs change on new items purchased, then you have different purchase costs for the same item in inventory, and that's the problem. The problem is, if you have different costs for the same item, the question is, how does QuickBooks know which costs to use when you sell an item and need to find the cost of goods sold for the items that were in that sale? For example, let's imagine on April 1, you have 3 apples in your inventory that you previously purchased for $10 each. Now let's imagine on April 2nd, you purchased 2 more apples, each for $12. Now here's where the interesting part comes in. On April 3rd, you sold 3 of them. Which 3 did you sell? They all look alike when they're sitting in the bunch. And then if you don't know which particular 3 apples you sold, then what costs get assigned to those apples for you to determine the cost of goods sold to subtract from your sales for that particular sale? That's the issue. Well, QuickBooks Desktop uses a special accounting method called the weighted average method. It's the average of all of the different costs that you paid for the item with consideration to the quantity of the item after each step. So, let's first discuss what a normal average is. Let's imagine you have 1 apple for $10, 1 apple for $12, and 1 apple for $14. If these were the 3 apples sitting in your inventory, then you know you paid a total of $36 for each of those 3 apples, and you know that the normal average cost for those 3 separate costs would be $12. And then you could use $12 as the cost of goods sold for the apples that went out. However, you would not normally use the normal average because that only considers the different costs without considering the quantity purchased at each cost. The weighted average method considers quantity in the average. So, let's imagine we have 1 apple for $14, 1 apple for $12, and we have 3 other apples that we previously paid $10 each. Now, we have way more of the $10 apples. So you can't just add 10 plus 12 plus 14 and divide by 3 because you're not considering that most of the apples were purchased for $10. So you have to factor this into your average, and we still have 3 different prices, but we have more of the apples that were purchased for $10. So you can't just add them up and divide by 3 and use the number 12 as your cost of goods sold, because the real average would have to be closer to 10 because you have way more at the $10 cost. So here are the steps to finding the weighted average so that you can assign a cost of goods sold to the items when you sell. Step 1, find the total quantity. Well, that's pretty easy, especially if you're using a computer. Step 2, add all the costs of all the items together to get the total cost. And of course, step 3, divide by, use division, divide cost by quantity, and then you will have come up with a weighted average for each individual apple that you could then use as the cost of goods sold the very next time you sell. So if this were the situation and we sold 3 apples, the cost of goods sold for that sale would be 3 times the $11.20. Notice it's a little bit closer to $10 than the original $12 regular average that we had, because if we have more at the lower cost, that tends to pull down the weighted average. Now let's try a second example just to make sure you got it before we go over to QuickBooks. Let's imagine an inventory right now. We have 5 apples at $13 each, 8 apples at $18 each, and 3 apples at $16 each. Now we know that the weighted average should be a little closer to 18 than anything else, because you have 8 apples at the $18 purchase cost each. So the total quantity is easy to calculate, and the computer will give you that. But this is displayed a little differently. So how would you get the total cost? 5 apples, well, what you would have to do is find the cost of each separate purchase and add it together. So for the 5 apples that you purchased at $13, you would multiply and find those 5 apples cost you $65 to buy. For the 8 apples that you purchased at $18 each, those 8 apples cost you $144. And for the 3 apples that you purchased at $16 each, they cost you $48. So these apples together in total cost you $257, and there's only 16 of them. So then when you divide, you come up with a result that's $16.06, and that is the weighted cost of each unit, the weighted average of each cost, and it would be that number, $16.06, that you would multiply by the quantity whenever you sold to find the cost of goods sold for that particular sale. Now let's see this in action in our QuickBooks file. Right now in our inventory, if you've been following along properly, you should have 273 apples physically available for sale. And your report should show that you paid $10 to purchase each of those 273 apples, worth $2,730 altogether. So, what if we purchased 100 more apples, but we purchased them at $12 each? What would happen? Well, what would be the new cost per apple that QuickBooks would give us? Right now we have 273 apples at $10 each, making $27.30 for the money amount of our apple inventory. If we bought another 100 apples at $12 each, that means we'd be paying $1,200 more for those 100 additional apples. And we know the total quantity after that purchase would be 373, and we know the total purchase cost of all apples after that purchase would be $3,930. Therefore, the weighted average per apple would be $10.54. So if we recorded this purchase, QuickBooks would then show us the new unit cost per apple in the report that we just showed a moment ago, but it would not say $10, it would say $10.54. And that means that any subsequent sale would have $10.54 assigned to the cost of the apples to calculate the cost of goods sold for that particular sale. So let's record that purchase. Let's imagine on May 2nd, 2019, we paid Sam's Farm $1,200 for 100 apples, $12 each. Well, it's very simple. Banking, write a check. And we said that was May 2nd of, we're doing 2019. Might as well do it right. We bought it from Sam's Farm. And no, we're not using a past purchase order. And yes, we're still writing a check. Don't worry about those 2 pop-ups. But do not fill in the money amount. Go to the items, choose apples, and the quantity is 100. However, we are changing the purchase cost from 10 to 12. Now, it's going to ask you, should we update with the new cost? No, because this might just be a fluke, who knows? Or you might want to say yes if you really feel that it's a permanent change. But the point is, we're buying 100 apples for $12 each, and we're paying Sam's Farm $1,200. Now, after we click Save and Close, we're going to open the inventory valuation detail. The new cost for Apple as of May 2nd is now $10.54. That means when we sell apples right now, the amount of apples or the quantity of apples that we sell will be multiplied by 1054 in order to calculate the cost of goods sold. So let's sell with the new cost. On May the 4th, we sold 10 apples to Candy and received cash. Let's talk about this. The sales income will still be $500 because the sales price each apple is $50 and we're selling 10 of them. So $500 is coming in. How much will be the cost of goods sold? How much does QuickBooks say that we paid for the 10 apples that we just gave Candy? Well, QuickBooks is going to tell us that we paid $10.54 for each of the 10 apples that we just gave Candy. And therefore, if we're selling 10 of them, that means $105.40 is the amount of cost of goods sold for that sale. Let's see if that's what QuickBooks does. We click Sale Receipt and change the date to May the 4th be with you. Now we're selling to Candy and we're selling her apples. Now the sales price certainly didn't change. So if we're selling 10 apples, we know that's $500 in income. But after I click Save and Close, I can open the trial balance and I can see if I go to Sales and double click the sales number, yes, $500 in income for sales. However, if I go to the cost of goods sold account and double click and go down to the most recent sale receipt here on May the 4th, you can see that the amount of cost of goods sold for that sale that we just recorded is exactly the number we expected, $105.36.
Chapter 25. The First In, First Out Inventory System, also known as FIFO. In order to know the gross profit and net income of our merchandise business, you must have an accurate calculation of the cost of goods sold. You must properly track your purchase cost of all items that were sold as well as items still on hand. There are 3 acceptable accounting methods to track your products' changing purchase cost. The accounting method that QuickBooks Online uses to track changing purchase cost is called First In, First Out, also known by the acronym FIFO. First In, First Out assumes the items of the same type are sometimes purchased at different costs. When selling the items, the accountant or the bookkeeper does not know which specific items were physically given to the customer in that sale. As you know, all apples look alike, even though we paid a different purchase cost for the different apples that are sitting in our inventory. Some of the apples you gave to the customer were purchased at one cost, and the rest of the apples that you gave the customer were purchased at a different cost. And you don't know which ones were purchased at which costs. All you did was grab the apples and give a bunch to the customer for the sale. Therefore, you cannot know for sure the purchase cost of the goods that were sold because you don't know which cost you purchased the apples that were sold. So what do? Well, FIFO assumes that the very first items, in this example apples, that were purchased were the first ones to be sold. So, if you know the cost of each purchase, then you can assign the cost to the ones that were sold. For example, let's imagine we start off with 4 apples in our inventory that we paid $10 each to buy. Now, if we sell 2 of them, we know the cost of goods sold is $20 because we know for sure we paid $10 each for the 2 apples that just went out. But now we buy 2 more and we pay $12 each for the 2 new ones that we just bought. So now after that, if we sell 2 of these, do we know the cost of goods sold? Well, it depends on which 2 did we sell. If we sold the 2 red ones, we know the cost of goods sold would be $20 each because we know we paid $10 for each of them. But if instead we sold 1 red and 1 green, that means we sold 1 for $10 and the other one we paid $12 for. So in the second example, if we sell 1 of each, the cost of goods sold would instead be $22 for that very same sale. FIFO assumes the first ones in were the first ones out, and the red ones came first. So which 2 did we sell according to FIFO? According to FIFO, we sold the 2 red ones, and in our first example, the cost of goods sold for that first sale would have been $20. But now let's imagine we buy 2 more and we pay $15 for each of the 2 new apples that we just bought. Now in the next sale, let's imagine we sell 3 of these apples. So there are 4 in front of us and we sell 3. Well, which 3 did we sell? The green came first, and FIFO says first in, first out. So we sold the 2 $12 ones, so far that sale is up to $24 in cost of goods sold. But we didn't sell just those 2, we sold 3. So we need to sell 1 blue one, and that means that adds an additional $15 what we paid for the blue one, and that gets added to the cost of goods sold for the sale. So for that sale of those 3, the cost of goods sold would be $39. Now we'll try examples with larger numbers, and if you need to pause the video to do some math calculation on a calculator or Excel, just to verify what we're doing, that's fine. Or you might want to watch the whole video, and then the second time around that you watch it, pause and verify the numbers that we're calculating are correct. So let's imagine we're starting in inventory with 150 apples that we paid $10 each. Now let's imagine we buy 200 more apples and we paid $13 for each of them. Well, that's fine. We now have 150 at 10 and 200 at 13, and you could multiply and figure out what the cost of inventory asset is. However, let's imagine now that we sell 175 apples. Remember, the first ones in are the first ones out. So if red was first and we sold 150 apples, that means red was first and we sold 175 apples. That means that all 150 apples at $10 each are sold. And we didn't have enough from the $10 apples, we actually have to have 25 of the $13 apples to make the 175 for the sale. So we're going to also take away 25 from the $13 apples so that after this sale, we're left with only 175 apples that we paid $13 for each of them. And multiplying 175 times 13 would be the inventory asset cost of apples after that sale. So we now have 175 apples at $13 each remaining in our inventory. But what was the cost of goods sold for that sale? Well, we sold all 150 apples that were purchased at $10 each, so that contributed $1,500 to the cost of goods sold. And then we needed to add another $25 to make the total 175 apples for the sale, and we paid $13 for each of those, so that contributed $325 to the cost of goods sold. So the cost of goods sold for that particular sale was $1,825. QuickBooks Online is keeping track of these numbers behind the scenes. There is no report that shows the breakdown of the purchase cost of each item on hand. The inventory valuation detail can help you figure this out, but you have to look carefully at it. It's not always clear. So if we go now to QuickBooks Online and we go Reports, Inventory Valuation Detail, let's scroll down to bananas. And let's use bananas for our real life example. I'm going to stretch this a bit here. You can see that right now on hand we have 280 bananas, and we paid we paid $20 for each of these 280 bananas, and that's why the cost, specifically the asset cost of just bananas, is $5,600 right now. So the inventory report before we buy bananas at a different cost is showing right now we have 280 bananas at $20 each. Now, let's imagine on January 25th we purchase 300 bananas from Sam and we pay $22 each. Well, if we do that, what will be in inventory? We'll still have 280 bananas at $20 each, and then we'll have another 300 bananas at $22 each. So let's go ahead and record that. In the top left, click New, Expense. This is January 25th of 2020. We bought from Sam's Farm. Oh, don't forget that we're paying from cash. Don't forget we're paying from cash. And by the way, let's close this because this is not related to any prior transaction. So we're paying from cash and bank to Sam's Farm on January 25th. Product and service is bananas, and the quantity is 300, and this is the first time we're going to change the rate. The rate is $22 instead of $20. Now look what happens when we click Save and Close. At the bottom of the inventory valuation detail, it's not exactly clear. You have to look closely. We had, on the 22nd, we had 280 bananas that we paid $20 each. Now we bought an additional 300 bananas that we paid $22 each. Now the quantity on hand is now 580 bananas, where 300 of them we paid $22, and 280 of them we paid $20. So it's not laid out as clearly as it is in my little PowerPoint. But basically, we have 280 bananas that we pay 20 each, and we have another 300 bananas that we pay 22 each. Now, here's where it gets interesting. On January 26th, we sold for cash 400 bananas to Candy. Now, if we sold 400 bananas, which ones did we sell? Remember, red was first, so that means we sold more than the 280. That means we sold all of the 280 at 20 each. That went out as part of this sale. But you see, we didn't sell 280, we sold 400. That means we need to take another 120 bananas from the bunch that we bought for $22 each. And if we bought 300 at 22 each, and we needed to take another 120 bananas out of that bunch to complete the 400 quantity sale, that means that what's left in inventory after this sale will be 180 bananas at $22 each. That's what will be left in inventory after the sale, because we had 300 of those $22 bananas, but we had to give up 120 of them as part of the sale with the other 280. So let's take a look. And right, what's left will be 180 at 22. Let's take a look at what happens when we make that sale. So that was, click New, and go to Sale Receipt. Okay, the date was January 26th, and the customer was Candy, and the item that we sold her was bananas, and the quantity that we sold to her was 400. Now again, don't worry about the sales price, we're focusing on the purchase cost. But what we should have left in inventory is 180 bananas at $22 each. So, let's go ahead and save this. Now, scroll down to the very bottom. Scroll down to the very bottom. You can see that what's left in inventory is 180 bananas. That's the ending quantity on hand after the last transaction. 180 bananas, and they're $22 each. And if you multiply the 22 times the 180, that explains the asset value, $3,960. But before we look at anything else, let's ask this question. What was the cost of goods sold for that sale? Well, all of the 280 bananas that were $20 each were given as part of that sale. So $5,600 was that part of cost of goods sold. And we needed to take 120 of the $22 bananas to make a total of 400 for the sale. So 120 bananas that we paid 22 each adds another 2,640 to the cost of goods sold. So the cost of goods sold for that sales receipt was $8,240. You can pause the video to check the math, but let's do this. If I double click this sale receipt, and then I click on More and go to Transaction Journal, you can see that the sales price, you see they break it up all crazy. They break up the cost of goods sold into pieces, so it's really hard to kind of determine what it is. Okay, what you could do is click Reports, Trial Balance. When they make it harder for you to understand. Cost of goods sold, if I double click this and I scroll down, you see what it does? When you have a sale that has more than one purchase cost for cost of goods sold, QuickBooks breaks it up crazy. It breaks it up, you see, 1014, 1, 2, 3, 4, 5, 6. It scattered it to 6 different lines, but I'm going to show you something. These 6 lines together, where is it? Can I do this? These 6 lines together for this one sale receipt, add up the money amount, I guarantee that it equals $8,240. So it would be nice if it would just show you $8,240, but it doesn't. It breaks it up crazy, but that's the way QuickBooks shows it. So FIFO would be challenging enough to understand if it put everything in one line. And none of the tech people actually gave a logical reason why that it spreads it out like that. So if you click Reports, Inventory Valuation Detail, go to the bottom where we have bananas, you can see what was given. You can see on the 26th, you can see that as part of this sale receipt, 120 bananas were given at the rate of $22. And that's what we actually said. We said part of this 400 banana sale, 120 of those 400 bananas were $22 each. And that is showing on the bottom line. 120 of the quantity that went out for this sale is for $22 each. And we also know that the other 280 bananas that are part of the 400 quantity sale were at $20 each. So, but what they did was they scattered that across several lines. So if you look at this, these are adding up, these will all add up to 120, guaranteed. So these are these will add up to the 280. So these 1, 2, 3, 4, 5 lines are the 280 bananas that we gave to the customer for $20 each. And in that same sale 1014, we also gave them 120 bananas that we paid $22 each. So FIFO would be a lot easier to understand if they didn't split it up like this. And to be honest with you, I really don't know, and neither do the tech support people know, why it splits it up like that in the report. But you will only have a transaction listed on several lines, one transaction for several lines. You will only have that in a transaction where there's more than one purchase cost for the item that you're buying and selling.
We thank you so much for watching this video to the very end. We hope you'll come back and visit if you need any help with QuickBooks or accounting, and please support the free help for everyone by clicking like, and please subscribe.